So excited to have you guys here. This is so the whole purpose of this full fundamentals course, right, is I just want you guys to understand that when you're when you're learning this information, I know most people already probably went through it, but when you're learning this information, the goal is to visualize yourself seeing how the markets move after economic data or any fundamental reason come out. Like the whole goal is to visualize it, see it first, learn to understand it, and then you could separate it by going into the actual charts, right? Because then it's just going to make, because once you can understand the direction, right, being able to trade it is going to make it so much easier. All right, guys. So I want you guys to, like if you have questions, like write it down. Try not to make this overly long, because I know like learning fundamentals could be extremely boring, but I think you're really going to enjoy this one, definitely. All right, one sec. So pretty much like what is fundamentals, right? Referring to analysts of economic, political, and social factors influences the value of the currency, right? So the whole purpose of understanding fundamentals is just telling you why and how the markets are moving. Okay, so that's the main focus of what we're doing here is why and how. When I was just trading technicals only in the very beginning, it was easy to identify candles moving up and down, but I was never able to identify, okay, why did this move happen, right? Because when I first started out, we all started out that way, just learning technicals only, which is nothing wrong with that. But I never found that much consistency in the markets, and I just never knew why. And every time I see a big move happen, yeah, you'd be excited about it, but you could never pinpoint why did this move actually happen. So that was when I actually came down to fundamentals and I actually got started into understanding these events when it comes to what is the things that we have to learn, right? Economic indicators, central bank policies, geopolitical events, economic reports and news releases, and global economic trends along with market sentiment. Like these are the things that we're going to be learning today, right? Most of you already know, but if you don't, these are the things that helps you identify why and how the markets move. Okay, so when we're going to get started is for economic indicators, right? These are key data points released by the government or financial institutions that give insight on the economic performance, right? And the things like GDP influence GDP, we should all know what GDP is. Most of us trade it all the time, measures the total value of goods and services produced in a country. I want us to understand this stuff because the goal is to become full analysts, full investors. We have to learn this stuff if we're trying to get into that next stage. It's just more than just looking at, oh, GDP, this is just an economic indicator. But what is it? High GDP growth can signal a strong economy, often strengthens the currency, right? Now, looking at inflation rates measured by Consumer Price Index, CPI. This has been the main indicator that we all be focusing on pretty much this whole entire year. CPI has been one of the main things that the markets is dialed in on 100%. Higher inflation leads to purchasing power, may lead to a currency's depreciation unless offset by higher interest rates. We're going to dive into that too, but first understand if it wasn't for the current environment that we are in now, do you guys understand that higher inflation typically weakens the currency, right? So the only reason why now, like, how come we get higher inflation print and it strengthens the currency is because interest rates is being involved. Because the central banks let us know their whole goal. What is their goal? What is their current outlook? What are they trying to accomplish? They're trying to accomplish lower inflation. And in order to get lower inflation, they need to increase rates. So interest rates is the next one, is what we're focusing on. Central banks set interest rates influencing the currency value. Higher interest rates often attract foreign investments, increases currency demand. Higher the rates go, stronger the currency. Lower the rates go, weaker the currency. Okay. Now, unemployment rates is another thing that we focus on is unemployment, labor data. High unemployment indicates a weak economy, which may negatively affect the currency value. So as you can see here, like how this is giving us why and how. Okay. What is GDP and how is it measured? Obviously, I just put this here just so that you guys can obviously get the definition and know how it's measured. It's good to know, but does it have to know? Not really, but it's good to know, right? We can see that GDP is a key economic indicator used to measure the overall economic activity of a country. This is that shows the importance of GDP because it just shows how well the economy is doing overall. This is what helps us understand, which direction the economy is going. Are we seeing a stronger economy or are we seeing a weaker economy? Right. So you could obviously have this point here. I don't want to like go over everything into detail, but you have the idea of it like when you're ready to look at it yourself. Okay, when you go through the PDFs. The next one is higher inflation rates are measured. This is extremely important every time that we trade because we know that inflation for the central banks is one of the main focus, but CPI is one of the things that we focus on. CPI is most commonly measured of inflation. It tracks the average change in prices paid by consumers of a basket of goods and services, including food, housing, transportation, and Medicare. Okay, how it works, basket of goods, right? Price collections. It may pretty much shows you how they determine that calculation is that they use all of this data to determine how high inflation is going. Then core inflation excludes, because this is the difference when we're trading inflation data. We have headline and then we have core. So the central banks mostly focuses on core because it excludes the volatile items like food and energy prices. Okay, so because central banks can't control food and energy prices, that's based off of people, right? That's just the consumers. So central banks' main focus is core inflation. That's mostly what they focus on. It is all important, but it just shows that why core inflation is the central bank's focus is because it excludes food and energy prices. Another CPI indicator that we pay attention to is producer prices index. So that's PPI. It measures the average change in selling prices received by domestic producers for their output. Okay, so you could understand the differences between CPI. We see that it measures the baskets of goods, services, food, housing, transportation, right? PPI measures the average change in selling prices received by domestic producers, okay? It reflects inflation from the producers rather than consumers. So an increase in PPI pretty much shows that there's just a higher cost, so that's higher inflation. So that's the differences when it comes to core, CPI, and then PPI. And then next we have PCE, personal consumption. So when we're looking at PCE, it measures inflation. It's the same thing, but it tracks the changes in price in goods and services consumed by households. So now we have three inflation measures that are different. The main focus, obviously, the central banks look at is CPI, but they also pay attention to PCE and PPI data as well. We all want to focus on all of these events, but at least you could just see the differences of each one. It's all not just being measured by just the same products. It's all different, measured differently, okay? But it all has the same impact. So how does central banks look at inflation? Inflation targeting, what is it? Central banks typically set an inflation target to 2% a year. So when you guys look at their monetary policy report, but it's on their website. Like if you go to federalreserve.org or EC, like europeancentralbank.org, they tell you what is their target, right? So they give you a benchmark. And that benchmark, it would determine pretty much their planning of making their decisions. Most of their benchmark is just like 2%. They want to keep it around 2% a year. Do they exactly hit that target? Most likely no. But they have a target every year. Their goal is like if inflation is higher than that 2% mark, we know that their goal is to try to keep it lower to that 2% goal. So we know that they're going to be trying to lower inflation. So you could see how that gives us forward guidance. If inflation is below the 2% mark, you know that they want to start increasing inflation. So now we could determine, like, okay, now we could understand their goals moving forward. So, inflation expectations. What is it? Central banks closely monitor the public's inflation expectations as they become a self-fulfilling. If people expect higher inflation in the future, this may determine higher wages, right? So this is like inflation expectations is it's every Friday we get that data, mostly every Friday, where we get it's like consumer expectations. We get that on Friday. Typically, it's like at 10 a.m. That's just expectations. So we could see how consumers is looking at this information. That's why on Fridays it could lead to some good opportunities, even though it's just expectations, but it's from the consumer perspective. If we see that those numbers are rising, that shows us that consumers are expecting higher price goods in the future, which is also included to obviously the central bank's decision. Now, we can look at monetary policy tools, interest rates, rising interest rates. When inflation is above target, central banks often rise interest rates to cool down the economy. So, higher inflation rates make borrowing more expensive. So, you can get the understanding of this because we're currently going through this, right? Higher interest rates make borrowing more expensive, which reduces spending and investing, leading to lower demand, lower inflation. So we've been dealing with higher interest rates lately. So this is the reason why most people was expecting recessions to come in, right? They're expecting the stock market to plummet because higher interest rates, it cools the economy. We just haven't seen a cooling of the economy, even with higher interest rates. That's the difference. But at least you can understand why the markets was anticipating a slowdown in the economy. Lower rates when inflation is below target or the economy is in a recession, right? Central banks may lower interest rates to encourage more borrowing and more spending. So where are we currently now for the US and other central banks? You have to figure, are we in a situation where we're higher interest rates or lowering interest rates? Because now when you understand, okay, they're lowering interest rates, but what is the goal? So now you see that, oh, well, they want to lower interest rates because they want to stimulate the economy more. So obviously that should be good for what? US equities, right? That should be good for the economy overall. So you get to understand what is the central banks trying to pay attention to. Now, quantitative easing is also known as QE. When a central bank buys government bonds or other financial assets, it's just to inject money directly into the economy. And this is what was happening over COVID, like when 2020, when COVID happened. They was doing QE because nobody was working. There was no money coming into the economy. So this is what they call like bailouts. The central bank is bailing out the economy by putting more money fluctuated in the economy just to boost economic growth. But the outcome of that is higher inflation. So this is why we've been dealing with higher inflation afterwards. And once you get the sum of everything, then you understand forward guidance. Central banks provide communication about future policy moves to influence market expectations. This is why I focus on central bank comments, right? Because all we pay attention to is how is their communication? What are they trying to tell us? Are they trying to tell us that they're looking to be more, they're trying to increase inflation or they want to lower inflation? Are they trying to higher interest rates or are they trying to lower interest rates? They tell us all of this with their forward guidance. And this is why paying attention to news headlines and just trying to pick out that individual thing that they say can influence the direction of the currency. So higher prices, Bianca, higher prices goods make dollars stronger. So the actual definition, because it's higher inflation overall typically weakens a currency. That's like if it what, but the only reason why in this current stage, because this may change in a few years, that we could see higher inflation numbers would weaken a currency. The only reason why now higher inflation is strengthening the currency is because of how interest rates is being influenced by inflation. Because the goal is to lower inflation. So we know that the central banks, if they see a higher inflation print, that may trigger them to keep interest rates high, or they want to raise interest rates to lower inflation. So the currency value is being manipulated by interest rates, because this may change later on in like another 2 years. When inflation hits 2%, and then now the central banks have another focus, and then we look at inflation data, higher inflation may weaken the currency, weaker inflation may strengthen the currency. Like other central banks, like if you look at the Chinese yuan, like you look at their, like, inflation is not really impacting that side of the country. So higher inflation really probably won't mean a stronger currency, because higher inflation is not going to dictate China increasing rates, right? So it just depends on their focus. But the real definition, higher inflation weakens a currency. But the fact of, in today's world, higher inflation is strengthening the currency because it influences interest rates. So that's how we look at it until things change. All right. So how does central banks make decisions on interest rates? So every time we see that these interest rate, when we have a rate decision coming up, how do we determine, how can we predict if they're going to increase rates, pause rates, right, lower rates, right? Because we understand that the central bank's main focus is controlling inflation. They want to keep inflation manageable to around 2%. Like promoting, they also want to promote strong economic growth, right? They don't want the economy to overheat. But the things that they do focus on is here. There's these key elements before they make a decision, right? Economic indicators. So they're focusing on inflation, employment, gross GDP. They're focusing on consumer spending. So they're looking at economic data. This is why I tell you guys, you know, when economic data come up, we have to pay attention to it, because they're paying attention to it. Because depending on how the data comes out, it can make them determine what they're going to do next with rates, right? That's forward guidance. So for instance, we're trading US CPI. We see that CPI data comes out higher than expected. Then we see that employment data comes out. Employment is strong. You know, we see that as strong labor data. Then we look at GDP. We see that GDP is coming out higher too, right? So when we look at those three prints, and we know that the rate decision is coming up in 2 days, like say that the rate decision is coming up next month, and we see these prints come out higher, I want to ask you guys, do you feel that inflation is going to come out higher? I mean, interest rates they're going to look to raise interest rates or lower interest rates, right? So when you see that coming out, it gives you a perception of like, okay, now I could understand which direction that central bank is going to go at this rate decision, because economic data is giving us a determination that it is hot, it is inflationary. We're seeing that CPI is higher. I can see that growth data is higher. I can see that GDP is higher. So all of this is giving me a reason to look for buys in that currency, because this is giving us expectations that they're more likely to hike rates. Right? So this is how we could look for our swing trades. That's how we could look for those long-term trades, is by focusing on this type of data, because this is what they focus on. This is how they make their decisions. All right. So that's why it's important. It's not like it's manipulating data. But now what is next? What happens if we see inflation is lowering? We see that unemployment is high. We see that GDP comes out as expected. Consumer confidence as expected. So now your decision is like, okay, so what is the direction of the currency now? You pretty much don't know. It's neutral. So that's where the expectations of rates of like a cut or a pause, right, would be 50-50. So now when we get to that rate decision, that's where we want to pay attention to number 5, which is forward guidance and market expectations. Because we don't have a clear direction, because data is not giving us one. So we need the central banks to give us an actual direction. So that is why we understand forward guidance. That's why you don't want to trade the actual number of the rate decision. You want to wait until the central banks tell us which direction they planning to go, what they want to see in order for the direction of the markets to go. All right. So that's why forward guidance is important, on top of paying attention to economic indicators. So I already probably went over the bulk of it in this stage, but we can see monetary policy goals, right? Obviously, every central bank has goals, and it's just more like dual mandate: focus on maximum employment and stable inflation. You just remember that for the whole thing, because that's their scapegoat, when they're like, oh, what is your goal today? Where our goal is to maximize employment and stabilize inflation. So that's the whole purpose of a central bank, right? So when so that's just monetary policy goals. That's just what they focus on. So the 2% target is literally what they plan on doing. Inflation targeting, we already want central bank meetings. So the central bank meetings, central banks have they schedule meetings 8 times a year for the Fed, right? Obviously, we went over that, well, how they review data and decide on interest rates. The decision making body, like the FOMC, is what it's called. So when you hear FOMC, it's the Federal Open Markets Committee. All right, that's where they discuss economic conditions and forecasts on trends. This is why when we focus on rate decisions, it's extremely important for us traders. It's not a reason for us to ignore it and say, well, this is how they manipulate the markets. Like this is how they make decisions on if the economy, like they tell us literally everything on if they want to, obviously. But this is where they give us, this is where we should be paying attention to. Are they trying to strengthen the currency, or are they trying to weaken the currency? That's the whole goal of paying attention to these meetings. Like, what is their goals now moving forward? This is how we can look for opportunities and understand why. Like, if a currency is strengthening or weakening, we understand why. Okay. And how interest rates are measured, good to know, but have to know, not really. But at least you have the definition here. You guys could go through it. Obviously, the policy interest rate is the benchmark rate. This is a short-term interest rate set by the central bank, such as the federal funds rate. I don't know if most of you heard that. But in the US and the ECB, it's called the main refinancing rate. And the UK, they call it the bank rate. All right. It is the rate of which commercial banks can borrow or lend reserve with the central banks. Changing in this rate affects other interest rates in the economy from mortgages and business loans. Okay. So that's just like the main definition about it. Unemployment. Like, again, I just want to give you guys just the definition, so now moving forward, when you see these data points coming out, you have an understanding, like labor data is important. Most people don't even know how to get the survey from it, right? It's just the BLS. You could literally go on their website. That's where they get the labor statistics. Most people don't even know it. So now you do, so when somebody asks you the question, you can understand, like, okay, this is how they track the data. This is what they look for. This is how they make their decisions. So this is just like more the whole purpose of how everything is going, especially for labor. So central banks on unemployment data. Assessing economic health. High unemployment signals weakness in an economy. All right. Leading to lower consumer spending and overall demand. How we could understand that is, like, think of COVID, think of 2020. What happened? We had high unemployment. People was put out of work. So what happened after that? Nobody was able to buy anything. Everything, demand of the overall economy, spending, everything went down. So when you think about that, which direction do you think equities is going to go? Right? So that helps you understand, like, okay, when I see this is happening, that tells me an actual direction in the markets. So what is low unemployment? Signals a strong economy. But also, this is leading to wage inflation, right? And businesses are competing for a limited pool of workers. So now when we see low unemployment, this is why that is also inflationary. But then we could also see how it affects the economy. So like today, like as of today, focusing on labor data, it's affecting the economy, not as much as affecting inflation anymore, but for the economy. So now if we see that more people is losing their jobs, we know that it's going to hit the economy even harder, right? So now that tells you, okay, how is the central bank going to make their decisions moving forward, right? So now we can see setting interest rates. If unemployment is rising and then the economy is slowing, central banks may cut interest rates to make borrowing more cheaper. This encourages businesses to invest and hire more workers, right? So that's the whole purpose of cutting rates, to make to make it easier for businesses to thrive better. So this is why in the lower interest rates, people will start buying homes, right? Businesses start doing better. So that's the whole purpose. So now when you look at equities, lowering rates, now I can see why equities and stocks are rising when we start lowering rates. Higher rates If unemployment is very low, inflation is rising. Central banks may rise interest rates, right, to help slow down the economy by making borrowing more expensive and reducing spending. So when a central bank is trying to rise rates, the whole purpose is to slow the economy down. So their goal is to make it harder for people to spend money. They're making it harder for people with their businesses, right? So that's the whole goal. So when they're raising rates, now when you look at the stock market, oh man, now I could see the stock market slowing down. I could see the stock market dropping. Okay. Now also we could look at quantitative easing and tightening. This is important to pay attention to when we're dealing with a crisis, right? Then you will see the terms of QE and QT, quantitative easing and quantitative tightening. Remember, this is all bailouts, right? So when we have an economic crisis, when you see these words, like during periods of high unemployment, which was like a 2008 crisis and 2019, COVID-19, the pandemic. Central banks may implement QE, quantitative easing. This involves borrowing financial assets to increase the money supply. So that's how, like the printer, like when we was hearing all that printer talk during COVID, this was because that was the time they was doing QE. All right. So that's how you're going to get that word. So QE, they're trying to stimulate the economy, right? Show more productivity in the economy. And quantitative easing is when they're trying to reduce it. They're pretty much trying to curb inflation. They're trying to take that money back. All right. Just to make it in simple terms. QE strengthens the currency. QT weakens the currency. Real world examples, right? If in response to high unemployment during COVID-19 pandemic, the Federal Reserve interest rates, they cut interest rates to near zero. This is why, like I remember when Trump, during the height of the pandemic, none of you remembered when Trump was out there saying like Jerome Powell needs to put interest rates to zero, right? So understanding how interest rates control a currency, what do you think that would have been a green light for you to start shorting the dollar, right? Because this is exactly what they did. When we saw that the pandemic happened, central banks put interest rates to near zero, right? QE programs to support the economy. As the economy recovered, the unemployment dropped. Inflation began to rise sharply in 2021 and in 2022. The Feds respond by raising interest rates. So I just want you guys to understand that, because with the information that you're learning now, can you see how, and all of this is being said publicly? Like, this is not like something that they're doing behind closed doors and we're just looking at the volatility of the markets. When they're having rate decisions, they're telling us what is the direction that they're trying to go. They're telling us, right? They're telling us on these rate decisions that they're trying to increase interest rates or lower interest rates. That gives us a direction. When we're dealing with a financial crisis, right? So we understand that, okay, in order for them to deal with this crisis, right, they want to lower interest rates to zero, which is weakening the currency, and then they want to stimulate it with quantitative easing, right? So that's the reason why, if you look at that time when COVID happened, or even through the 2008 financial crisis, when the central banks implemented those tools, we saw the currency drop, and then we saw the stock market rise. And then when you see them try to reverse all of that, then you see them, right, they raise interest rates. So the whole purpose is, how can we catch this, right? Because when we listen to central banks, they're not very clear. They're not gonna speak it in what's the word, like in our terms, where we could like a normal person is listening to a central bank meeting and they're gonna know like, oh, they're trying to strengthen the currency. They're not gonna word it in a way where the average person understands, right? So this is why, like, paying attention to economic data from here on out, when you're reading these headlines, try to understand those key words. When you see QE, you know that's quantitative easing. When you see quantitative tightening, you know what that means. When you're looking at economic data, you could see, oh, is this strengthening or weakening the currency? So when you're looking at data, when you're looking at these information, this is what's going to help you determine which direction you should go. Okay, so that's what really helps, right, in the long run. And it's just about going through the experience. And we're lucky enough that we was able to get all of this in a short period of time. Because typically from 2008 all the way to COVID, how many years is that, right? We typically go through a decade in order to see a shift in monetary policy. We was able to get that from 2020 all the way from 4 years. We saw every situation with a change in monetary policy, and we saw how the markets reacted. So now moving forward, it doesn't matter the situation, right? The reaction, the tools that they use is always going to be the same. So that means that the reactions of the markets is typically always going to be the same. Maybe next time won't be a virus. It could be a war. It could be maybe it could be another some other shit like another virus. Who knows? But there's always a major event that causes a change in monetary policy. So we just have to whatever that major event is. It could be a financial crisis. It could be a banking crisis. The reactions is still going to be the same, but that's where we find our opportunities. All right. So now we're just going to go to the next slide. Are you guys good? Just put a one. If you have questions, now is a good time. All right, good. Continue. So now this is the important stuff, right? When it comes to central bank policies, and I know that it may seem like it's a lot of shit. Like I understand, but trust me, like once you get the hang of it, it's not really. It's just understanding it first, and then you're gonna learn how to apply it. But first, you got to understand it first, because then you know what to look for. So central banks like the Fed, the ECB, the Bank of England play a crucial role in determining the currency's value. This is why I'm everything has is revolved around the central banks. You're trading a currency. And your first question is should be what makes a currency stronger and what makes a currency weaker, right? It's like I know it's easy to just say let's looking at a chart, but these are the people that dictate the value of the currency. It's not day traders. Okay. So it's like if you're looking at a chart, you're looking at price action, it's like you're saying day traders and traders is what influences the direction of a currency. It's not that. Monetary policy. Central banks uses tools like interest rates, quantitative easing, and they control inflation to stabilize the economy. Right? That's monetary policy. It's just tools of interest rates, QE, and requirements that they try to use by stabilizing the economy. So when a central bank member says, yeah, we're trying to go into our tools, our monetary policy tools, then pretty much they're meaning like, okay, we're trying to either increase rates, or they're trying to do something with interest rates, they're doing QT or QE, or they're trying to figure something else out to control inflation or stabilize the economy. So tools is rates. That's one of the things that they use. That's what most of them are using now, right? Intervention is another tool, right? And there's a few others, but the main ones is like interest rates. We know QE, QT, and intervention. Interest rate decisions. If a central bank raises interest rates, the currency value strengthens. Okay, like just an example. Forward guidance, communication about the central bank's policy. So I just want to implement this into you guys' head, so that when it's time when these things come up, you already know. All right. So central banks, it's multiple central banks out there. I just put the main ones here, like the Federal Reserve, the Fed. Again, when it comes to their mandate, they all have the same, pretty much the same mandate. 2% target is a definition for each one. The ECB, we can see 2% target there. Uh, we could just this is just their mandate for currently right now. Like this thing could change in the next 2 years, right? But this is just the mandate of what they're trying to do. Like the Bank of Japan, right? For an instance, the Bank of Japan remains the outlier with the ultra loosening monetary policy. Continuing, continuing is near zero interest rates because the Bank of Japan is one of the lowest
out of all the central banks, Bank of Japan is at literally 0%. It aims to combat deflation and boost economic growth, focusing on achieving to stable 2% inflation target. Unlike other major central banks, the Bank of Japan is expected to maintain or slightly rise its inflationary pressures, right? Inflationary pressures to increase, right? So the Bank of Japan, out of all the other central banks, they're looking to lower interest rates, lower inflation, right? Inflation is high for other central banks. Bank of Japan, inflation is below zero. Like they're trying to actually increase inflation. They want to get out of deflation. So just understanding that, because just last week alone, just for you, last week alone, we had Tokyo CPI. It came out higher than expected. We see that this is their mandate, that they're trying to combat deflation, right? So we see that inflation is rising, right? They want to boost the economy. So, but obviously everything changes because now they're looking to hike rates now because inflation is lowering. But when I wrote this was the actual mandate. Now it changes. So it shows you that in every other few years, they have a different focus. Each central bank have a different focus. They have a different target. Right now, each central bank, besides the Japan and besides China, is to lower inflation. So in order for lower inflation, they need to keep interest rates higher. But trading it day to day could be different because now we see that the Feds are cutting interest rates, right? Because they see that inflation is actually going to target, right? So this is just the definition overall. So how central banks influence a currency? Interest rate adjustments, raising and lowering interest rates. So we already understand that part. We already went over it. But this is how they influence a currency. Quantitative easing and tightening. We already went over that as well. But just to give you the definition, QE is when a central bank buys financial assets, government bonds, such as government bonds. QE is to inject money into the economy. QE is to increase the money supply. And it typically weakens a currency because there's more in circulation. Somebody just asked me a question of like China found more gold. Does that strengthen or weaken gold, right? If there's more of it if there's more circulation of it, it obviously weakens the value of it. So just think of it that way. Quantitative tightening is just the opposite of QE. When a central bank sells assets to reduce the money supply, QT tends to strengthen the currency as it reduces the amount in circulation, right? So when it comes to them, when they make words, they literally tell us all of this during their rate decisions. And remember, QE and QT typically happens during a crisis. Obviously, the last thing that they did was QT. So that's why we've been seeing the dollar rise pretty much after COVID happened. We've been seeing a strength in the US dollar, right? Because they've been doing quantitative tightening. Now, foreign exchange interventions. This is what the Bank of Japan does, but also the Swiss National Bank. Because remember what I said, the tools that they could use, intervention is one of the tools that they used also to help lower inflation at that time. But intervention, Bank of Japan does it. Switzerland does it mostly. The Bank of England did it once. I believe this was like earlier this year. The Bank of Japan did it once. But pretty much a central bank directly buy or sell its own currency in the foreign exchange market to influence the value. We can't trade against that. Typically, sometimes they don't tell us exactly when they're doing it, but they give us hints. Like when we're looking at the Bank of Japan, they're like, oh, we're watching the financial markets because if it gets too weak, we're going to have to intervene. So when they say that, they're looking to actually buy their own currency in the financial markets, right? So buying their own currency reduces the supply and strengthens it. Selling their currency increases supply and weakens it. An example, the Central National Bank has been known for intervening in the Forex markets to prevent the Swiss from becoming too strong, which could hurt its exports-driven economy, right? Because there's always a reason for why they do it. Typically, it has to do with trade. It has to do with exports and imports, okay? And then also now forward guidance and communication. So again, this is extremely important because when we're trading, we're most like the markets are forward-looking. The markets ain't going to wait until the rate decision sometimes and then say like, okay, let's just buy because the markets will never move. right? Forward guidance, when we're looking at forward guidance and communications, central banks uses speeches, press conference, right, just to give us signals on future monetary policy actions. A hawkish tone, because I like to say this is a hawkish language, this is a dovish one. So when I say hawkish, it suggests that future rate hikes, it suggests future rate hikes often leads to a stronger currency. When I'm like, this is a dovish tone, he sounds dovish, that means rate cuts are prolonging lower rates, right? Usually weakens the currency. So when Jerome Powell, he's making a hawkish statement, traders typically anticipate a stronger dollar. Like the most recent comment that he had, where he was signaling that we should be a little more concerned about heading towards next year because of physical policy, because of Trump's election, and also he's talking about employment is still strong. So that's more of a hawkish tone, right? So that's why we saw the strength of the dollar when he said all of that. But now, how could we take advantage of these moves, right? So how us traders take advantage of these moves? So an example is trading central banks, right? Central bank announcements. When we see that a central bank, they're likely to increase rates. That gives us an opportunity to look to buy that currency. It's just examples, right, that we could look for. I know that a lot of these opportunities can be very quick, but when you first start trading it, you're going to start understanding it. You're going to start paying attention to it. You're going to see like how these events can actually lead to us taking advantage of good opportunities, like monitoring economic data for central bank clues, like paying attention to economic indicators like inflation, GDP growth, and employment data. These provide clues, right, for us to determine a central bank's action for that rate decision, right? Just forward guidance. Anticipate central bank decisions can position ourselves accordingly. Like if inflation surges in the US, traders expect the Feds to hike rates sooner. That could lead to strengthening of the strengthening of the dollar. So this is why you like when people's like, oh, how could I catch swing trades? It's like you have to look for clues when it comes to economic data, when it goes into the central bank announcements, when it comes into forward guidance. Like think of it that way, like it's a game. You're looking for clues. Like, okay, does this signal that the Fed should be increasing rates or should the Feds be lowering rates, right? You're looking for clues to look for tradable opportunities, right? That could lead to long-term profits. All right, guys. Yeah. No, so let's go now to central banks, how they make interest rate decisions, right? We already covered this, but again, good to know. You know, it's just the details that matters the most. But how central banks make their interest rate decisions, we know that it's economic data, right? So if we see that inflation growth, unemployment, wage growth, consumer spending, if they see that this is actually going higher, this makes the central bank hawkish. All right. And when it's lower, right, when we see all that data is weakening, that makes it more appealing for investors to want to weaken the currency. That makes the central banks want to start cutting rates, right? So just economic indicators. So understanding the central bank's objective. Remember, I went over their mandate. What is their goal, right? So is all the data above their mandate, or is it below their mandate, or is it going to the mandate? So that's how you can tell the direction of the central bank, because now we see that if their target is 2% and inflation is still at 4%, right? We know that they're still looking to lower rates. So they're not changing their mandate yet. We know that their goal is to get inflation to 2%. So now we have an overall bias. But if inflation is below 2%, now we know that they have to change the mandate. Now they're trying to increase the inflation to get it at that 2%, right? So that's why the mandate is important. Geopolitical events. Central banks also consider geopolitical events such as wars, trade disputes, and physical and political instability, which can influence economic stability and market sentiment. We're going to go over that later too. Central banks often look at market expectations such as future pricing, bond yields, market sentiment indicators that may lead to rates in alignment, right? It could change interest rates. So geopolitical events such as wars, or it could be COVID, right? That could influence their decisions on rates too. And we already went over forward guidance. Now, lastly, when it comes to how we position ourselves, right? When we're looking at, we have to analyze central banks' communication. Remember what I was saying is when the meetings come out, is it hawkish or dovish, right? Every time we're reading comments from central banks, we're trying to figure out, is that member at that moment giving us a hawkish language or a dovish language. That's the goal of analyzing central banks. Economic data, we went over that. We're trying to determine, does data also show that the central bank should be hiking rates or lowering interest rates, right? We could see, we look at it the same way, so you don't get confused. Is economic data hawkish or dovish? So that you could get an understanding of that. And market sentiment, market sentiment, like one of the things we could watch is the Fed Watch tool, like the CME group. The Fed Watch tool, it just shows how the market pricing is showing future rates. Like I used to always show that CME report where it's like, oh, like now the market's expecting for December, they're expecting a pause. So understanding that gives us the idea of sentiment. This is just market sentiment. It's not the central banks doing it, but it's how the markets is positioning themselves for it. Risk management, we're going to go over that later. But yeah, we just covered how central banks went over. And again, when it comes to these stages, it's good to know, but at least you could get the understanding of it. What about tariffs? How does that impact the currency as a whole? I got that covered too in here too. I'm going to get into that as well. Economic data. So when we're trading economic data, how can a pause affect currencies? A pause is, it depends on the current state. But right now, if the central banks, like the Federal Reserve, pause interest rates, if it's about forward guidance. So put it this way, if the markets is anticipating them to cut rates and they pause, the currency could strengthen because you're keeping rates where it is. And if inflation is high and they saying that, oh, inflation is in restrictive territory, inflation is still high. If they do a pause, that can strengthen the currency if the anticipation is for them to cut. Right. But if we are in the hiking, if they're trying to hike rates and interest rates are low, and if they pause, that could weaken the currency because they're expecting them to rise. So a pause could either not cause a major reaction or it just causes the opposite. So if the Federal Reserve pauses rates right now, it could strengthen the currency because they're expecting them to continue to cut rates. So it's all about what's happening currently. But it's about forward guidance. Like if we see that data, everything is showing that economic data is lowering, right? And we see that the central banks, all right, this shows that the labor data is dropping, inflation is lowering. We should expect the central banks to cut rates. So that would weaken the currency. But in the rate decision, they pause rates. That would strengthen the currency because they're expecting them to cut, right? So that's why. This is just an example of how I'm gonna breeze through this part, like economic data. How we could look at data. So just like an example, we got non-farm payroll, CPI, the rate decision, and other indicators like retail sales and GDP growth. But this is also for people that don't know. So when you're looking at economic data, you're going to get the indicator. So that means, okay, what is the actual data about the country? So which currency is going to get impacted by that data? You're going to get the previous. The previous is last month's number. And then you get the actual. That's the one that we wait for to come out, right? But in free sources, you get I didn't put the forecast, but you get the previous, the actual, and the forecast. And other ones, you want to get the expected low and the expected high. Because when we're looking at economic data, the numbers, like the forecast, is not random. It is all the banks. They're determining what they expect the data to come out as by the information they provide. So then the forecast is just the median of all of their expectations of where they expect that data to go. Okay. And an example, if we see that it's expected at the previous is at 2,000, right? For like non-farm payroll, 200K. It actually comes out higher than the previous or the forecast. That could typically strengthen the currency because that shows that that number is getting higher. So we understand non-farm payroll. We know that, okay, this is labor data. This is for the labor markets. So if the data is coming out higher, that shows us strength in the currency because we see that the labor data is actually going higher. Like the same thing with CPI. We feel like UK CPI, we see the previous is 6%. So where their expected low is at 5.2, the expected high is at a 6.5. If it comes out at 5.2, it actually is lower than the majority number. So that's where we could get the surprise numbers from because it's below the expected low. And it's also lower than the forecast. So when we see it go lower, then we expect a weaker pound because we know that inflation, the central bank is looking at inflation to determine rates. So if they see that the previous is at 6%, the data actually come out that moment and is at 5.2. That shows that the data is lower than expected. So when we're looking at data, you want to understand, okay, what is the data? I could see that, oh, it's CPI. What country is it? It's the UK. So when you see that, okay, so what currency is for the UK? You know that's the GBP currency. So most likely that currency is going to get impacted by that data. So now when you look at the actual when it comes out, that's what's going to tell you if that's going to weaken or strengthen the currency. So if we see that CPI, that number is lower than expected, we could expect a weaker pound currency. But what if this number came out at a 6.3? We know that it's higher than expected. So then we could expect a stronger currency. Okay. And that's just like an example, and pretty much just giving like an example. I just went over it already, but at least you can understand how to look at data moving forward. So yeah, we just move. I'm gonna move forward from that because I'm pretty sure most of us could get it, but I pretty much covered it. When you're looking at economic data, when data comes out, first you want to see, okay, what is the data point? Like, is it important? How is this data going to impact interest rates? How is this going to impact the markets? Because is it one of the main focus? Is it GDP? Is it CPI? Is it labor? Right? Is it growth? First, you got to determine which one is it. Then you look at, okay, so if the number comes out above, how would it impact the markets? If the numbers come out below, would it impact the markets? Because everything that we went through before in the past, what is the central bank's focus? Are they trying to lower inflation? Right. So that means if this is CPI data and inflation comes in lower, right, that should trigger potential rate cuts. Right. That should give us a trigger to look to sell the currency. So that's how you could determine how economic data shows importance. And that's how we're able to understand it and look for opportunities moving forward. Right, guys? And yeah, I'm gonna just move forward now to let's go over geopolitical events. All right. Because I know you just talked about tariffs, and I do like. Did I cover it? I put it in a video in the course actually, but I talk about the tariffs part too because that just happened recently. But I did a video in the course, so if you go through, I did an extra video about Trump when he announced it and how the markets reacted. So yeah, but I don't think I put it in here yet. I don't think I put it in this section because I did all of this before. All right, so moving forward. So now when it comes to geopolitical events, this is important because we're currently dealing with all of this now. So it is important for us to pay attention to and understand how to take advantage of it, right? Like elections, political stability, uncertainty during elections can provide and can infect investors' confidence. Uncertainty, like Brexit, this is probably what happened before. A lot of you guys never was there during Brexit, but I was blessed. That's pretty much around the time I was starting with trading. Like trade wars, like tariffs, trade restrictions can weaken a currency's economy, influence its currency, right? So trade wars is what we're currently going through right now. So tariffs is just trade wars. Okay. For instance, the US and China trade war can affect both the US and China. But how will it affect it is going to be super key, right? Geopolitical events often can significantly impact the foreign exchange markets. So what we trade, the forex markets, as they can create uncertainty, influence in monetary policy decisions. This is what the markets is expecting when Trump comes into office. His political stance by how tariffs is already coming in as an impact, not just for the U.S. but for the whole globe, right? How it could impact monetary policy now. Also, how wars can also impact monetary policy, just determined on the actual reaction, like how Russia invaded Taiwan
and the US started putting sanctions all in Russia. So right away, we know that, oh, they're putting so much sanctions on Russia. We see that the Russian ruble devalues in currency. But now they had to use tools of monetary policy because now, whatever the tools that Russia has did, we could see that their actual currency started strengthening. So they had to do adjust monetary policy when these effects happen. Okay. An example, Brexit. These are just like examples of what happened and how did the markets reacted. Because remember, when you go through these, it's not about like, oh, let me see a chart. It doesn't matter. You have to see when a situation happened, how did it affect the currency? Because once you can see that there's a situation, you understand how that situation can impact the markets, and then you can look at the opportunities afterwards. But you have to see the situation and understand the situation and how the situation can also impact the markets. That's what's key, okay? Because this is a thing that helps us become better investors. Once we have a cause, we can understand the effect. And that's what's extremely important. When we're looking at data, when we're looking at these geopolitical events, we can see it has an impact, but what is the effect, right? Because once we can understand that, that's how we take advantage of these opportunities. Brexit. We know that Brexit it significantly impacts the pound and the euro. Why? The UK decision to leave the European Union created a massive uncertainty about the future economic relationship between the UK and the euro. Investors sold off GBP fears economic instability, leading to a sharp decline in its value against the dollar, euro, and the JPY currency. So when you look at the GDP happened when Brexit happened, you look at the currency at that time, GBP USD fell 8% immediately after the results. So understanding that Brexit, okay, this is the pound leaving Europe. Everything when it came to their future, their relationship, trades, and everything, the economy was when they was joined with Euro. So when they left, it was like, okay, now how the fuck they're gonna figure it all out by themselves? Investors in decision sell the currency right away because of uncertainty, right? Now, if we understand if there's another event that happens this way, I don't think there's any other current countries out there. Like maybe like if like say if France choose to be on its own, then we know the outcome. You know that would be a different outcome, right? But at least you could understand how it affected. Like COVID-19, we talked about it a lot. Most of us started trading during this time. So major currencies like USD, Euro, and JPY, and emerging currencies was also impacted as well. But this was global, right? This was global. The pandemic caused global economic shutdown, leading to a flight in safety. This global shutdown, because it was global, so it's like, where do we invest in? Right away, when you see that this is a global event, this showed us that safe havens is what gained a lot of strength, right? Because of it was unpredicted. So safe havens gained strength, which the dollar rose. We saw that safe havens like the yen and the Swiss strengthened as well. But emerging markets like the peso, the ZAR, and the Turkish lira, that's TRY, weakened significantly, right? Because there's other opportunities. You could also trade safe havens, you could trade equities, but this doesn't just impact the main currency. This impacts everything. But you have to learn like what other assets got weakened. Like why did the peso get weakened, right? Because it's emerging market currency and it also weakened too. Okay, it's not a safe haven. So these are the things that could also tell us how to now if there's another pandemic, right? Say for an example, monkeypox became an issue, right? They're trying to start that shit again, right? What did your eyes light up because you already went through it already, right? What happened when what was it called? It was called it happened in Africa. They tried to start it again. I think it was not Ebola. It was I forgot the word. It happened in Africa. And in Africa, like their leaders were saying that it's not serious. But Europe and the US stopped domestic flights going into Africa when they got that virus. It was Amaricron. Amaricron. Yeah, so when Amaricron happened, the reactions was the same way like COVID-19 because they thought that this was going to turn into something big.
But it was all about not just because people was getting sick. It was just, okay, what is the outcome when this happens? What is next, right? That's when they started locking down flights. Right away, that's a trigger. Which direction you think oil is going to go? Because the same thing happened during COVID. When people stopped traveling, what happened to oil, right? So these are the things that when you understand when these events happen, because God knows something else might happen again. The reactions of the markets is going to be the same. Russia, Ukraine, we're currently still going through that. We just literally went through this a few weeks ago, right? What gets impacted when Russia and Ukraine start? What gets impacted? That should be the first thing. Euro, the Russian ruble, commodities linked like CAD and also Australia because they're linked to commodities. The war led to a significant economic sanctions on Russia, which led which impacted energy markets, especially in Europe. The euro fell due to concerns about energy shortage and economic stability. The Russian ruble also collapsed later because of the sanctions. So what did what Russia do to help boost their economy is by interventions, right? So that's why I was like, when you look at when the Russia Ukraine war started, you see that you saw that the Russian currency weakened in value. Then after that, you saw it strengthen because they started using interventions to boost their currency, right? But why did euro get impacted? Because their relations to Russia when it comes to energy. So this is why euro is an important currency to pay attention to this conflict, because if escalations do continue, because euro is a part of NATO, so Europe is directly involved in the actions that is going on between Russia, Ukraine, and the US and NATO. So Russia is kind of giving like a big fuck you to Europe, right? So like, oh, it's freezing over there. You're gonna freeze to death. We're not gonna stimulate. We're not gonna give you oil, pretty much. So that's why the European currency dropped in value when all of that conflict happened. But now you understand what happens if there's a truce. So now if there's a de-escalation in the conflict, you know that's going to be positive for euro, right? And also you know that's going to be positive for like AUD and CAD, pretty much, right? So that's how we understand what's going on. So when these escalations started coming up and again in the markets, and the markets is reacting, we understand the direction because it happened before. So it's no surprise why euro dropped the past what was like a week ago, 2 weeks ago. Why euro dropped when the Russia-Ukraine war started, when Biden actually gave nuclear weapons to Ukraine, and then Russia was like, we're going to defend ourselves no matter what, and the euro currency dropped in value, was because of this. And this is not by surprise. This happened before when it first started, right? So something to pay attention to. Now, what we're currently dealing with now is trade wars with the U.S. and China trade wars, right? This is all about the tariff situation too. The Chinese yuan is the CNY, the USD currency. These currencies export-driven So these export-driven currencies like the AUD also gets impacted. I don't think I put it in here, but Australia and China, they're trade partners. So this is why of iron ore. So this is why, like, if you look at GDP data, and I have this also in intermarket analysis, that's the section that I'll go over with that as well. Like when I'm looking at China's GDP or China's growth data, like PMI or GDP, I don't directly trade CNY. But if we see that China is being impacted negatively, that could also hurt the AUD currency because of how they're trade partners. But let's move forward. Why the imposition of tariffs by both the US and China lead to concerns about global economic slowdown? The US initially strengthened as a safe haven, while the China currency weakened due to fears of reduced economic growth in China. So when a tariff situation comes in play, most people would expect both the dollar and the Chinese currency to weaken in value. But the dollar can still rise because it's a safe haven, but we know that's going to weaken the yen currency, the Chinese currency. So when these tensions continue to escalate, and we can see that it gets worse, this happened already. So now again, the opportunity would be when Trump comes in office, and we see that's one of the first things that he does, we could see that the China currency could actually weaken. And also, When that happens, we can see that AUD and NZD may weaken, right, due to this heavily reliance on exports to China. So that's what we look for those opportunities when those tariff situations come impact, right? It will be, and also that whoever's directly getting impacted, like he did say, like the peso, right? Mexico, we can see that the peso currency is also going to weaken in value because he's telling us, well, we're going to hit a direct tax. We're going to hit this percent of tariffs on your country, X, Y, and Z. We know that's going to directly impact that currency. So when these tariff situations come in play, this is the reaction of the markets because it's not the first time. So we understand the direction. So we just have to wait for that opportunity to come. The debt ceiling that only pretty much comes once in a blue. This happens all the time when the U.S. debt ceiling comes in. It's more political standoffs. That's what it really is. Does it really have a major impact? Only if they want it to. If they're making it a big deal. We know that they make it a big deal by how the markets react. We will see safe havens gain strength, but usually the debt ceiling shit is all bullshit. It's typically just a distraction. But the Gulf War, the Middle East conflicts, this is still what's going on till this day, right? Iran, Israel. We could see, we still going through this stuff today. You're in the Middle East, pretty much. So when these escalations start, we could see spikes in oil prices. And it's funny because when I first started trading oil, I remember this story. I took a buy. I think I took a yeah. I took a buy. No, I took a sell. Yeah, I took a sell over the weekend on Friday. I took a sell in oil, and I was holding that shit just to hold it, right? And there was a bombing in the actual facility, in an oil facility, and I'm like, I didn't know any of this shit, right? I didn't know any of this shit. So when that actually happened, I was hype over the weekend. I was like, yo, this is good. Like, I'm expecting this to weaken oil, right? So this has got to be bad for oil. I think the price is going to drop. Man, when market open, like literally that should like rise like $15, bro. And blew like literally just went through my stop loss. I got slippage. Yo, fucked up my whole account. And I was like, oh, holy shit. Like ain't this supposed to be bad for oil prices? But now I understand when Middle Eastern conflicts often leads to spikes in oil prices, right? So now I know, which can impact oil exporting and importing currencies differently. The U.S. is often affected due to U.S. Geopolitical involvement. So that's why when we see that this Middle East conflict is happening, the question is like, why isn't equities reacting? It depends on their involvement, right? Because like what has happened in the Middle East doesn't directly impact U.S. companies. It impacts oil. So that's why oil prices can be one of the main focus. So if we know that oil prices can be impacted, most likely the CAD currency could get impacted. Like I should have went over intermarket analysis first, then went to geopolitical events. But this is why, because CAD and oil is connected. So this is why if we see a rise in oil prices, CAD currency can follow. But these events directly impact oil because it has to do with Saudi Arabia. It has to do, we can see everything regarding the Middle East, and it has to deal with oil prices. So when Biden said that Israel, like it didn't even happen, but Biden came out and says that Israel better not attack Iran's oil facilities. Just him saying that there was a possibility that Israel will attack oil facilities, right? Bombing their facilities, just the speculation increased oil prices. And then when Israel came out and said, we're not going to do that. Like, we're not looking to do that. We're not going to attack oil. We're not going to look to attack their oil facilities. Oil prices dropped. Okay. So that's why paying attention to those headlines is important. But now when we see the Middle East conflict, we can see what gets impacted. But what can also get impacted is the yen currency, the Swiss, because it's a safe haven, the dollar. So equities, U.S. equities, but oil, yen, Swiss, they get impacted when there's escalations happening because it strengthens as a safe haven. And I'll go over that in risk sentiment too. But I should have went over intermarket and risk sentiment first, and then went over these geopolitical events. The debt crisis, not really important, but Trump's election. This was like in 2020. This was in 2016. So what was impacted? U.S., peso, and China. What is the odds that now he's getting elected again? We see the same reactions, right? What is the odds? So imagine just learning this information And when you see that, oh, he's about to win, like you have an understanding on which direction the markets could go, right? So none of it is a guess, right? Where it's like, man, I can't figure this out. Now you understand because these are the things that happened before. And even if it's not Trump, like imagine if there's another person running for president, like what is their agenda? Like, are they trying to, like, do they have the same outlook of the economy the way Trump does? Like, he's trying to put American first policies, include tax cuts. He's trying to boost the U.S. dollar. Like, he's trying to cause tariffs in other countries. He's trying to stop wars. Like, so understanding, like an election, you have to understand the political party and their agenda. And this could go for any country, like the Baker Japan, like Japan, with their election, the people that's currently running, they're currently trying to keep ultra easing policy. So meaning that they're trying to keep rates low. They're not trying to strengthen the value of the currency. So you know if that person wins, most likely that's going to weaken the yen even more because they're not looking to strengthen the currency. But who they're voting against, whoever's against them, they're trying to raise interest rates. They're trying to promote more activity. They're trying to put in more jobs. So if that person is winning in their election, then that's most likely giving you a reason to start buying the yen currency because you see that how their agenda, how their actual policies is going to impact the economy. So that's how the markets reacted. So why Trump's policies cause these reactions? Includes tax cuts, increased physical spending, right? Increasing physical spending is also what? Is also inflationary. So that's another reason the dollar boosted. However, fears of trade wars, right? He already said he's going to tax Mexico and China, but he also included this time he included Canada. But this happened in 2016. Initially, we saw dollar strength, right, from physical stimulus. That's inflationary. But the yen, the Chinese yuan, and the peso weakened due to trade restrictions. So I hope you guys understand. Like, imagine having this information before. So when you see that, okay, this is what he's trying to do, you're not gonna look in. You're not gonna look to buy the peso. You're not gonna buy the Chinese yuan, right? You're looking for every opportunity to sell the shit, to sell the hell out of it. What do you think banks and institutions like JP Morgan, what do you think institutions like Vanguard, BlackRock, like what do you think they're doing with the peso in China right now? You think that they're buying it or you think they're selling it, right? They're not looking at a chart and say like, oh, well, this is showing me that the peso is going to weaken because it bounced off to this fib. Like all that is good for confirmations, but they're looking at this stuff to determine the direction of the market. Long term, you think they're going to be buying the peso or they're going to be shorting it? But if the Chinese the Mexican government and or the central bank they do something with their policy to obviously try to strengthen the currency, then we know like okay, don't short it no more because we understand monetary policy now, right? So if we see that they're trying to do something different now to strengthen the peso currency, now we can say okay, we can look to strengthen it because now that what if the Mexican government or their central bank for Mexico they try to do intervention, right? We already know if they're trying to intervene in the markets, we know that they're trying to strengthen the peso. So right away, like they're looking to, because I know why they're trying to do it, right? Because of this situation with tariffs, and now they're trying to strengthen their currency. So now that could give me a direction because I know this information already, right? So that's the opportunities that we look for. And also, what else is important with geopolitical events is it's like national disasters, but it just depends on the destruction of it. Like this one was a Japan earthquake and a tsunami, right? National disasters could lead to like Japanese companies bringing money back from overseas to help rebuild efforts. Like it really depends on the national disaster. Like with Florida, when we had that hurricane, most people were like, oh, is the central bank's going to intervene? Like most likely not. But in other countries, it really just depends on the country, like how heavily, like if it was like half of the United States wiped out, like then most likely we probably gonna need some stimulus, right? But if it's just like a state for the US, it's not really a big impact. But some other countries is very small and they have a central bank. And if this is destroying like major companies and it's like, oh wow, there's no way we could rebuild. They don't have money. The central banks can come in and they could do intervention, right? They could come inside and then they could cause intervention. And that's how they could, if you see that, oh, they're coming in, they're trying to actually put more money into the economy and stuff like that, you know that. And it's also determined on the reason behind it, right? So they're trying to help rebuild. That could also cause trading opportunities as well. And also, lastly, yeah, the Saudi oil facility attack in 2019, and this impacted U.S. CAD and the Norwegian Quran was the NOK. This attack led to a sharp spike in oil prices, affecting currencies linked to oil exports. So that's why those currencies got impacted. And this is, again, this is an intermarket analysis, but you can see like when oil facilities get attacked, right? This is how currencies, you don't have to trade oil directly, but if you want to trade the currency that is attached to the oil prices, when oil prices rise, you can see that, okay, CAD and the NOK currency also rose in value because oil prices spiked up higher. All right, guys. And this is just the key takeaways. Again, I'm hoping that this is very informative, right? But I'm gonna just keep this going. Just let's just get over. I know you guys got the recording. You also have access to the PDFs. But if you guys have questions, just write it down if you're confused with something, and we could just I'll get it down. All right. But I want to go forward into market analysis, sentiment analysis. So all that this is the overall mood for the markets. This is what I like to focus on majority of the time when there's no economic data going on, right? There's no reasons in the markets. I want to see if the markets is risk on or risk off, right? Because typically we don't need a reason, but sometimes it could help us with a direction. So this is what sentiment analysis is. It's just when you hear terms like a risk on market, right? Investors feel confident. They're willing to take in more risk. Where you hear terms of risk off, investors are more scarce and uncertain. They're looking to protect their money into safer assets. Okay, so that's just the differential risk on, risk off. Risk on could also hear terms like optimism, right? Risk off, you could hear terms of market fear, market greed. Market greed is risk on. Risk off is like fear, uncertainty, and doubt, like FOMO. Those are terms that you will hear. Typically, I just like to say risk on or risk off. All right. So when you hear risk on, market optimism, right? So what is a risk on market? And again, this is what I like to focus on when, if I'm trading a session and there's really nothing going on, I want a direction in the markets. Understanding risk on and risk off is what could really help you be in the right direction, right? So also if there's something bad that happens, right, or something good that happens, right, it could cause like what is risk on? It could cause a risk on market. So in a risk on environment, investors are willing to take in more risk, right, searching for higher returns. This sentiment shift has a direct impact on high yielding currencies like AUD, like NZD, right, and also the CAD currency for several reasons. High yielding currencies like AUD, NZD, and CAD generally have higher interest rates compared to other major currencies like the US, the yen, or the euro. When investors are confident on a risk on mode, they seek higher returns, making those currencies more attractive. So currencies like AUD, NZD, and CAD are known as commodity currencies because of their economies heavily rely on exporting commodities. Like AUD is linked to iron ore, coal, and natural gas. NZD, New Zealand, is strongly tied to dairy, ultraculture, right? CAD is linked closely to crude oil and natural gas. So when we have a risk on market, AUD, NZD, and CAD typically strengthens in volume, right? Because investors want to get into riskier assets. Also, a riskier asset is US equities or equity markets. So that could be US 30, NASDAQ, uh, what else? S&P, right? It could be and also the equity markets impacted by those currencies as well. So when we see a risk on market, you're looking to see AUD, NZD, and CAD strength with US equities, and safe havens get weaker. like the yen, the US dollar, and the Swiss. This is exactly why uh, I have this chart, right? You can see it here. In the top, I have AUD, NZD, CAD. In the bottom, I have the dollar, yen, and the Swiss. So this is how I could determine if the markets are risk on or risk off. If I see AUD, NZD, and CAD strength, and I see dollar, yen, and Swiss weaker, that is more of a risk on market, right? Especially if I see equities rising as well. So that's what helps you determine, like, oh, is the markets reacting risk on or risk off? Okay. Now, what are causes of a risk on market? So when you see these examples, that should like help you determine like, okay, this could cause a risk on market. So now I have a direction for these currency pairs. And I know like throughout all of this, most of you probably already witnessed a lot of this movement, a lot of these events, and just didn't know like, oh, why did this cause a risk on or risk off market, right? So easing of inflation concerns, right? So when we see that inflation is lowering, this just the expectations of inflation is lowering, that pretty much lowers the likelihood of aggressive rate hikes, right? Because we know that if inflation is lowering, higher interest rates weakens an economy. That market fear. But the reason why they're raising interest rates is because inflation is rising, right? So if we see that inflation is lowering and it's happening globally, okay, that's a good sign for the economy. So that's what could cause more optimism in the markets, right? At those times. So that's where we could see like opportunities, like a possible risk on market when we're genuinely seeing a risk off currencies looking inflation is looking to ease. So that's what could cause a risk on market. Secondly, this is important because we're currently dealing with this now. Positive developments and political tensions. Because now this is no surprise. We know that this caused a risk off market, but what we just had recently, where there was a peace negotiation with Iran and I forgot well, Israel, sorry, not with Iran yet, I don't believe. It was with Israel and I forgot the other name of it. But recent peace negotiation between Russia and Ukraine reduced fears and prolonged conflict. And with Iran and Israel, obviously, it prolongs conflict when there's a ceasefire talk. Those negotiations, right? The reason why is risk on geopolitical stability reduces uncertainty, making investors willing to buy or risk your assets. Tensions easing, right, can help cause a risk on market pretty much. The tensions easing is what's going to be supportive for AUD, NZD, and CAD. All right. China economic stability, economic stimulus measures. I think this was like 2 months ago when China, they did a stimulus package trying to boost consumer spending. China has a big influence globally. So whenever we see any positive economic situations coming in from China, that could cause more optimism in the markets. You see that the equity markets rise at that time. So when we see that China's trying to boost with stimulus, they did this probably. Yeah, I know they did this. I think it was like 2 months ago. This is what could cause more of an optimistic market. But also when China is going through a massive downturn, that could also cause market fear because of how much influence China has in other economies. Okay. Also, dovish central banks. So if the comments is leaning towards a pause or a slowdown in rate hikes, the reason why that could be more of a risk on market when you're lowering interest rates, you're boosting activity for the economy, right? You're allowing companies to take more money, hire more people, put out more jobs. People want to spend more money. The people want to take out more loans and spend. So dovish central bank statements could cause for a more optimistic market. This is why equities have been rising this whole time. Not just looking, but for the whole year, we've been seeing equities rise, right? We've been seeing more of an optimistic market due to dovish central banks, right? Improvement in global growth forecasts. There's a thing called the IMF. I know you asked for websites. If you go to the IMF website, I think it's imf.org, They give their projections on so recently upgraded global growth projections due to stronger than expected recoveries in major economies like India and Eurozone. Why this is important? Like when global growth forecasts improve, investors expect higher returns in riskier assets, right? So the IMF, they pretty much give their projections on stability, on growth, on every economy, every country. The IMF is pretty much like above, like little, like it's like stages. The IMF is like above the central banks, but they give their statements once in a while, and then seeing that they're seeing positive growth can cause a little cause market optimism, right? And also earnings. This is another thing why the equity market has been rising this whole time. We've been seeing stronger companies, earning reports is coming in higher, so we see that companies is still strengthening. This also helps us determine, right, which direction equities could go. Stronger companies boost in economy growth. Lastly, what was another risk on market when Trump got elected for presidency? His expectation and views, right, because of the political party. Well, we see that their expectations is about boosting the economy. That caused market optimism. People want to start risking more money. You see that people like literally investing heavily now, buying the stock market, right? Buying crypto. So it just shows more growth, but also dollar strengthened because of his inflationary concerns as well. Makes sense, guys? If it makes sense, just put a one. But I know that again, you guys have the recording. At least you could get the understanding of it. The goal is to when you see these things happen, it's going to start clicking. It's going to start clicking, and then it's like, oh shit, I remember this happened before. Oh, okay, now I can see why the market is moving this way. If I see that, oh, China's stimulus package coming in play, I know that could cause more market optimism. Oh, fuck, maybe I should buy. You could buy the Chinese stock market, or you can even buy U.S. equities because that's a risk on market. Oh, I see that they're trying to bring monkeypox and they're trying to use this as a concern, and this is happening in South Asia, and then we see that they're stopping transportation over there. That could weaken oil prices. That could cause market fear. I know so all of this helps. So moving forward to what is a risk off market? Just everything opposite, pretty much. But a risk off market refers to a financial environment where investors move away from riskier assets or pretty much favor into safer investments in a period marked by increased caution. So when you hear a risk off market, just think of money just flowing, right? Money is flowing from riskier assets, flowing to safe haven assets. Just think of it in that way. Money just flowing for because they're not just taking the money out, putting it in a bank account, and then they put it some. No, they're just taking money. They're just transferring wealth. Oh, we're uncertain right now. We just want to put our money into safer assets so I can at least keep my money, right? I don't want to risk in the stock market because that's a high risk asset and I'm uncertainty. I'm having caution. I want to I want to be safe. So they will take their money out of the stock market, right? That's why the stock market dropped. And then they put their money into like bonds, not the yields, bonds, or the dollar, the yen, and the Swiss and gold. And that's why those increase in volume. So you see pairs like AUD, NZD, and CAD in the equity markets weaken, and then you see safe havens gain strength, like the US dollar, the yen, and the Swiss franc, and also gold. Okay, so when you see a risk off market or you see anything of that nature, you just think of safe havens gaining strength. And what causes a risk off market, right? Economic uncertainty, like slowdown, right? Poor GDP is important, and high unemployment and declining in consumer spending. So when we see, that's why GDP is important. And this is what the central banks tell us. So it's not a surprise. The central banks is literally telling us like, hey, we're looking at we're looking at unemployment data because we're not looking at it from a factor of inflation anymore. We're looking at this as growth. So if we see weaker unemployment, then most likely that's a sign of recession fears. That's what could cause a risk off market if we see big drops in labor data. Okay. So another one, geopolitical tensions should not be a surprise. Trade disputes, geopolitical fears. Why did the yen gain so much strength in the past 2 weeks? Because of geopolitical concerns, right? Why did the dollar gain strength? Because all of this tensions going on, Russia, Ukraine, and Iran and Israel, right? That's why Why the equity markets drop? Why did gold rise so much? Why did gold rise so much? Because of geopolitical tensions. Market investors already know they're not looking to buy equities. You know what? What is the safest asset when there's uncertainty? Gold. So this is why if you look at gold prices, why it's been rising this whole time? Because this whole time we've been having market fear, right? We've been having uncertainty. So now we understand if they what we're going to go over that later with gold. Central bank actions, tightening of monetary policies, right, such as increasing rates. This was before when they was raising rates and rates was at all-time highs. They was expecting a slowdown in the economy. This is why we kept hearing those recessionary fears coming in play. Oh, we're going to be in a recession. Oh man, the lag is going to happen, and we're just going to go through so much shit. It never happened, but this is why they was expecting it because this is what happened in the past. We just never saw that actual slowdown. Is it may happen next year? Maybe, but this is why they're anticipating it due to interest rates being higher. All right, financial crisis, and like we already went over that as well. That causes a risk-off market. Economic data, the important economic data to pay attention to see if there's going to be a slowdown, right? It's going to be like PMI, right? Because that's, we already went over that too. PMI is just growth. Retail sales, right, is just consumer spending pretty much. And rising inflation, like all of that can and also GDP. But this is what gives us sentiment, right, that we could pay attention to if the overall economy is seeing economic contraction. Like if you look at PMI data, if those numbers are below 50, it's contraction. So that's where recessionary fears come in play, right? GDP comes in lower, PMI. That's what the markets pay attention to see if are we in a strong economy or are we in a weaker economy. So contraction, you know, is bad. If you see PMIs below 50, if we see 3 bad GDP prints, that's most likely a recessionary fear. That could cause a brisk off market. Now let's look at gold. Most people like to trade gold, right? What is gold versus the dollar? The inverse relationship. So this is what helps you try to be in the right direction of trading gold majority of the time. So safe haven status. Gold is considered a safe haven asset. Investors flock to gold when there's uncertainty in the markets and when they lose confidence in fiat currencies like the US dollar. The dollar weakens, investors often look for other stores of value, increasing the demand of gold, right? Currency pricing. Gold is priced in US dollars. So when the US dollar strengthens, it takes fewer dollars to buy the same amount of gold, leading to a decrease in gold prices. When the US dollar weakens, gold becomes more cheaper in other currencies, boosting demand and driving prices up. Okay. Also, inflation is an inflation hedge. Gold is seen as an inflation hedge against inflation. So when the dollar loses value due to inflationary pressures, gold prices often rise as investors seek, you know, just higher purchasing power. Because that's one of the reasons why trading gold during inflation is tough, because gold is also a commodity. So remember, higher inflation typically weakens a currency, but gold is also a commodity. So higher inflation does also strengthens gold as well. But just the focus of right now in today's economy is interest rates. So we know that if interest rates are rising, it strengthens the dollar, which is also why gold weakens if we get a higher inflation print. But at least you understand the perspective, long life from a long-term perspective. And like gold versus the US 10 yields, right? That's why I like to look at the US 10 yield. And just the definition, you know, obviously you just see if the dollar and the yields rise, typically it should weaken the value of gold. If we see the dollar and the yields lower, it should typically strengthen the dollar, right? Opportunity cost. Gold is a non-yielding asset, meaning it doesn't generate interest or dividends. When the US 10 yield rises, the opportunity cost of holding gold increases as investors can get a better return by holding bonds. Good to know, but have to know, not really. But this typically leads to a decline in gold prices as money flows out of gold into high yielding assets. Just a typical, if the yields rise, it weakens gold, right? So inflation and rate expectations. The reason why I like to look at the interest, the 10 yield is because it shows rate expectations. So when the yields rise, or we see like higher interest rates or stronger economy growth, higher interest rates make bonds more attractive compared to gold. So when we see that the yields are rising, that's just increasing rate expectations to increase. So that also what boosts the dollar. So we see that we're looking at a possibility of higher interest rates, stronger dollar, stronger growth. There's no market fear, no reason for gold to increase in value as a safe haven, right? So that also weakens gold, makes it less attractive. Okay. And also the inverse. Risk sentiment. If treasury yields are rising due to optimism about economic growth, investors may move out of safe haven assets like gold. But if the yields rise because of inflation concerns, gold might still be supported as an inflation hedge. All right, so that's one of the reasons why I like to compare the yields and the gold together, right? Just look at it from an inverse relationship. And this is just like the dollar and the US 10 yield, the positive relationship, right? Just so that you could just understand the definition, so So now you don't have you have a source where if somebody's like, oh, like why does a dollar follow the US yields? Right? So monetary policy. When the Federal Reserve signals an increase in interest rates, treasury yields usually rise because investors demand of higher yields to offset expected inflation. So when the markets are expecting interest rates to rise, we see a reason for the yield prices to go. That's why I like to you look at the yields as an indicator of higher growth. Okay. So now foreign investment, higher treasury yields attract foreign investors. This is a reason why, like, it's not just the US 10 yield that we watch. Like you could I have the chart here. You could look at all the other yields as well. Do you have to like it's just guidelines? Do you have to? Not really, but at least you get an understanding, right? Because if we see that the yields are lowering, that's just giving us a projection of lower interest rates. If we see that the yields are rising, that's giving us a trajectory of higher interest rates. So the higher rates go, giving us expect more investors and probably more attractive to start buying that currency higher because we see that the yields are rising. And then the opposite, if we see that it's lowering, it makes it less attractive. All right. But this one, we're just talking about how the yields and the dollar correlate. Not all currencies follow. Like the Japan, Japan does actually follow, but they make it a concern at that moment because the bigger Japan, like they have a yield, they have a percent of where they're not trying to have the yields go above. Before that 1%. So if yields is rising above 1%, that strengthens the yen currency because then it's just showing investors that, oh, it's likely that the market is expecting a hike. Okay. So when you see the relationship, like this is just a summary of the relationship. Gold versus the US dollar, inverse relationship, dollar up, gold down. Gold versus the US 10 yield, inverse relationship, yields up, go down, and vice versa. US dollar versus the yields, positive relationship. Yields up, dollar typically up. So because the currencies is directly impacted the interest rates. All right. So if we see that if interest rates is potentially looking to rise, that's most likely telling us that the yields is going to go up. That's what gives us a story of how investors are feeling. So if we see that the yields is rising, then we understand that that should probably strengthen the currency. So that should have an inverse relationship. But we always need a reason behind it. All right. So key factors to watch: Federal Reserve policy, interest rate decisions. So this have a heavily influence in both the dollar and the yields. Inflation data, obviously we look at that of how it could impact the yields. Geopolitical risk, we know that uncertainty of geopolitical tensions. Economic data also is super key. This is why, like over New York session, I always like to look at the yields to tell me the story if the markets is actually thinking this is going to increase rates or lower rates. Is this inflationary or deflationary? Right. So understanding this could help you anticipate movements in the markets. Right. It gives you a really good understanding on anticipation moves. So yeah, this I just jumped around. That was market said. That was really the end of it. But let's go to intermarket analysis before that. So intermarket analysis. I know I'm speeding through it, guys, but just if you guys have questions, just let me know. You also get the recording anyway, so you could just go through it yourselves in your own pace. But this is just like to help you get the summary and learn how to put it all together. All right. But fundamental analysis, let's go to intermarket analysis right here. Let's cover this part. So intermarket analysis, it's just understanding the relationships, right, between like commodities and currencies and equity markets and currencies. So that's just all that it is. Like if oil rises, impacts CAD, right? And this is one of the reasons why like AUD is heavily tied to China because this is where they export in the destinations. So that's why iron ore is 20%. This was in 2022. It could be different now, but this is why AUD have a strong connection to China. All right, just to give it like an example. Yeah, pretty much. New Zealand. Another thing we could see that it's heavily they're heavily exported in culture and like we see like milk, dairy, and where does it go? To China, and also look where it goes, Australia. So that's how we could tell. That's why I typically don't want to trade AUD NZD, right? And you see China. So that's why, like, if anything negatively happens to China, we can see that AUD and NZD also has a major impact. So you don't have to trade the Chinese yuan. You don't have to trade China. You can look at AUD. It could cause an impact. So that this is exactly why. It's just chart right here. This is New Zealand. Um, other ones is like currencies in the stock market, right? When stock markets are bullish, risk on, investors may seek the higher return assets, boosting higher yields, right? Like remember we went over the yields. So this also depends on the current time of the markets. Because most people would look at it and say, oh, if the stock market is rising, should the dollar rise too? But it all depends on the actual outlook of the markets at the current moment. Because what's really driving it is interest rates, right? And also inflation. So US dollar and the US stock market. Often when the US dollar strengthens, the US stock markets may face downward pressures, especially, from a multitude of companies. A stronger dollar makes US exports more expensive, potentially lowering overseas revenue for US companies, and it may impact stock prices. This typically is like, is it happening now? Right now, it's not the focus. But for other currencies, like in Japan, right, that would be more of a focus. Like New Zealand, Switzerland, that they're strengthen their currency. This is why they be trying to cause intervention. This is why they pay attention to this stuff, right? Because this is the current focus for something like Japan and Switzerland. But this is an example also that can happen for the US if that also becomes a concern. But this is a concern for Japan. Like Japan has a strong export driven economy. A weakened yen generally benefits Japan exporters, boosting the stock prices, right? So that's one of the reasons why. Tradable opportunities. If the yen is depreciating due to the Bank of Japan's monetary policy easing, traders may go to long the Nikkei 200, the Nikkei currency market. Stock market is the Nikkei 225. Japanese exporters like Toyota, right? On the other hand, a strengthening yen may lead to a sell-off in Japanese stocks. All right, so they pay attention to this stuff because of how it impacts exports and also imports. Good to know. Most of you, if you trade it, at least you have the definition. But if you don't look at it that way, you don't have to really focus on it. And also currency and bonds. We just went over that, like how the bond yields have a direct impact to the currency's value. Okay. And this is just like understanding the bond market. This can be confusing, but eventually it takes time. But this is why, like, we just look at it from a current, like, how could it impact us trading today? Just look at the 10 yield, and this is how I say it. Like, the bond price is just inverse the 10 yield. If you look at the chart, it's just inverse. All right. So I just like to focus on the yields. Okay, because the yields is typically going in the same direction of the currency. But here's just a definition so you can understand the relationships. And we already pretty much went over that. Currencies and interest rates. We went over this as well. But understanding that higher interest rates typically attract more investments to a currency and it strengthens it. So just think of it that way. When we see that interest rates is rising, it's making investors want, like, oh man, this is an opportunity, right? So they want to invest into the markets where we see higher interest rates. But why is intermarket analysis important to Forex? Because Early signals can provide early warnings, right, of market changes. For notice, if commodities like oil are falling, which direction you think CAD will go, because we understand how the direct correlation CAD has to oil. So it gives us an opportunity, even if you don't want to, you don't trade oil, but you don't trade oil, but you could look at CAD, and that could be an opportunity. The same thing like what happens with China. If China is going through turmoil, we see that China is looking to depreciate. We could be looking for opportunities on AUD. So this helps you make better decisions in the markets by understanding these correlations, even with the yields. So if you see that the yields are rising, you're not going to want to you're not going to want to sell the dollar, right? But that also comes to other questions. But what happens if the yields are rising and the dollar is lowering? Then you know to stay away, because it doesn't make sense. If the market is expecting interest rates to rise and the dollar is weakening, maybe I should figure out why the dollar is weakening. But it doesn't mean I should just force a trade. That shows me that I should stay away because it doesn't make sense, right? Like if I see that data supports that the Federal Reserve is hiking rates and I see that the currency is weakening, maybe I should not take a trade. I'm only looking for buys. If the buys only happen an hour after, I'm gonna still look for those buys. I'm not gonna take sells just because I see markets is just lowering in price. That's the fake out. Like if we know that like economic data, news, whatever, war happens, we see that they bomb oil facilities and we see that oil prices is dropping at the start. It doesn't mean you chase the sales. It's like, wait, this should increase the value of oil. And typically it does. We just have to wait for the price action to align with our bias. And most of us don't tend to do that, right? So it helps make better decision making. So if you see these things are happening, you know the direction. So you have a trend. It's gonna help you align with your strategy. So it doesn't matter, like again, how you like to trade. What you use fibs, it doesn't matter. But it helps you make a better decision to be in the right direction. But also risk management is important, regardless, adjusting your risk. And just as like practical examples, right there. Obviously, we already went through this, but if you see, imagine you're trading Euro USD and you're noticing the US stock market is declining and you're seeing a rise in the US yields, gold prices are increasing, right? That could help you. It just helps you go bearish on Euro USD, right? Because you see that the yields are rising, that strengthens the dollar, right? So you see that gold is rising, kind of gives you like a little bit of that risk on market, right? Equity, the stock market is dropping. You see that the yields are rising, gold prices are rising, the dollar is strengthening. When you look at Euro USD, that could be an opportunity to short because now you're seeing all of this is correlating with a stronger dollar. So that's helping you understand. It makes you make better decisions, right? So that's one of the things, that's what really helps me. Oh, how you could stay consistently so long, like how you can understand what's happening with the markets, right? I'm like, damn, how you catch these moves? Why you like how you're able to wait for these opportunities? Because when these opportunities come, I already understand the direction. Like I already understand what to look for. I know what pairs to look for. I know what's getting impacted. I know what's not being impacted. Right. So when I'm looking at these things, I already have an idea. Right. So that's the whole goal of all of this is when you're seeing this stuff happen, you should already imagine, okay, what is going to get impacted in what direction. Right. So that's the start. The problem is with most people is that they're trying to figure the shit out before that. They just trading, just to trade, buying and selling shit. And they just don't know why and what and why. Right. But you have to understand how and why. That's the beginning of the fundamentals. You have to understand how and why. Once you're going to understand how and why, everything else is going to start coming into play. You want to be a great investor. When there's a cause, you have to understand the effect. If you can't understand it, then you're not ready yet. Understand that first. But most people just want to just rush through the process. And this is why, like most people struggle, for a very long time. And I was just saying this to somebody before. It's like you're confusing forward progress with movement, right? Most people is just thinking that, oh, I'm just trading technicals all day. And man, like I have some good days and I have more bad days than good days. But some days I just can't find consistency. And then you try to study some other fucking course that's just teaching you technicals only. So that's just confusing. You're moving forward, but that's not forward progress. That's just movement, right? So you can see the difference, like how this can help you with forward progress. because when these opportunities come, that's where you start making money. Like we look at Nancy Pelosi, they're like, she's she's doing what's the word for it? She's illegal trading, right? She's inside trading, but the opportunities come when she take trades is when the reasons behind it. She's not just buying a stock just to fucking buy it. She knows that, oh, okay, well, this tech company is going to release this report and this is going to be positive. So I'm waiting for that. I'm going to buy now because I know that's going to happen. Then the opportunity come, we see the prices rise. Those are the opportunities. It's not like it's just randomly buying and selling shit. Everything comes with opportunities, and there's always reasons. There's always opportunities, always reasons. But the hardest part is just waiting for it. All last week, we had nothing but reasons. And people still tend to trade when there's no reasons. Russia, Ukraine, reason. Trump's tariff fears, reasons. Trump's election, reasons. Iran, reasons. Right? We have reasons, economic data, reasons. But some people still want to trade when it's 4 p.m. in the afternoon. Right? So that's what's going to separate you. You know, forward progress is key. I want to go over risk management because the whole purpose of risk management, it doesn't matter. Again, it doesn't matter what you learn. You know, it doesn't matter like who you learn from. It doesn't matter who's teaching you. It doesn't matter. It don't matter how good you are with education. It don't matter. This isn't a sport, right? This is the financial markets. If you don't use proper risk management, because you cannot determine the direction of a move, right? What's going to keep you in a game long term is having good risk management tools, right? Risk management is also a strategy. You know, like that's one of the things that I think not a lot of us understand. It's like risk management is a strategy as well. You know, it helps you minimize losses. You always want to think about keeping your wins bigger than your losses. Most people do that shit ass backwards. Most of us, like, we maximize our losses and minimize our wins. Setting appropriate trade sizes. This is what's key first. You have to set an appropriate lot size based upon your account and also understand how to set proper stop losses. Like the psychology behind risk management. Like this is very crucial because trading is not just a numbers game. It's also about managing your emotions. Without the right mindset, even the best risk management strategies, you're going to fail. You know, you have to have, that's why, like, you know, psychology is super key. You know, we have to work on everything that we possibly can to build our psychology, you know, to have us make the right decisions. Having good risk management, it prevents making emotional decisions, right? Because if we don't have the proper risk management, we always going to have those emotions of greed and fear, right? We're going to be closing trades because we're in drawdown. You know, we're just going to be taking profit just because we see a little bit of profit. We're afraid for it to come back and hit our stop loss, right? So having the proper risk is what helps us with that. So it prevents that emotional decision, you know, and using proper risk, it builds confidence. Because when you know that your losses are controlled, because that's what we can control. You're not going to close your trades early. What if you're right, but you're closing the trade because you got $100 account and you're trading a one lot, right? And it moves down 3-4 pips and you blew your whole account, right? So you have to use proper lot sizes, and this helps you. It develops discipline because you're training yourself to not act impulsively, and you're making decisions that help you lead to a long-term success, right? So it helps you with discipline. All of this helps with discipline. Like when you're focusing on creating the right risk management, right? You're going to focus on making the right choices every single day. And then this also helps manage your losses, right? Because most of us struggle to accept losses because our losses be too big. But if we understand that, okay, well, I have a set lot size for a loss, I already understand how much I am risking. Most people, when we enter a trade, we don't understand how much we're risking until we lose it all. Right? Like until that shit hits your stop loss, that is like, damn, I didn't expect, damn, that was a big ass loss. Like, fuck, man, I just fucked my whole account up. But if you know that's going to fuck your whole account up before you take the trade, you wouldn't put that lot size. So before you enter a trade, you should know that. You know that a lot of us make those mistakes. You know, like the best risk management practices in forex, right? Obviously, is position sizing, risking a small percentage of your capital. You know, like, and I want people to start doing this after you go through this, right? Just risking 1 to 2%. Like an example, you have a $10,000 account, you should only be risking $100 to $200 per trade, right? This ensures no significant loss. Uh, this is what prop firms still do, and people still blow that shit because they like they give you risk parameters, and people still over leverage, right? But which risk 1 to 2%. Like if you're trading a $10,000 account, you shouldn't like you don't want to take a $5,000 loss because you're thinking about long term, right? Eventually, when you start adding and compounding, eventually your lot size is going to go up. All right. Using stop loss orders. Always set a stop loss order to limit maximum loss. Obviously, if you see motherfuckers out there trading with no stop losses, you know that most of the time they just full of it. You know they full of it. Like we've been in this game long enough. We understand that because it's like if you're not controlling your risk, then you're gambling, right? That means when you take a loss, you take a very big loss, and eventually you will take a big loss. So you're not showing people those big losses because obviously that's just not proper risk management. You know that. You wouldn't even give that person your money if you see how they're trading, right? So using that is very key. Avoid over leveraging, right? With both potential gains and losses, it has to be cautious because when we over leveraging, we're only thinking about the profit side. It's like, yo, if I put a 5 lot, man, this could turn into 5K. But you only got a $500 account. That 5 lot is going to blow your whole account if it just pulls back 3, 4 pips, right? So we're not even thinking about the long term gain. We're only thinking about the profit side. When you start trading, thinking about the law, like, oh, what is the worst thing that could happen? So when you start thinking about it from that perspective, that's what's really going to help you in the long run. Don't think about it from the positive side. Start looking at it from the negative side. Like, why is it important for us? It reduces emotional stress. A lot of us get stressed in the markets. We're like, damn, like I don't know, I don't even know if this shit is for me, right? And it's all because you ain't using proper risk management, right? That's all that it is. Because if you take a loss, you're still going to be in the game, right? Because it increases longevity. Because it prevents traders from blowing their account, right? Traders could remain active in the markets. So when you think about risk management, you're thinking about still being in the game for the next 5, 10 years. But when you're over leveraging, that's just literally shortening your growth as a trader. Because when we use risk management, it's important because it supports consistent growth. Controlling risk, we can now grow our accounts steadily, right? But what most of us do, we risk our account in like 2, 3 trades, and it doesn't work. It doesn't matter if you have $100 account because most people are like, oh, it's just $100, fuck it, right? For that, just go to the casino. But with this, work on just consistency. Most people can't even sustain $100 account for 2 months, for like not even a week. Try to sustain $100 account for 2 weeks. Proper risk management. Most people can't do it, right? So that's why it's just super important, when it comes to risk management, right? So why is stop losses important in trading? We should all know this, but sometimes a lot of us have to just go through this training shit again, right? Because it helps protect your capital. Stop losses help protect you from significant losses. No trader can predict the markets 100%, right? We can't predict it 100%. So use a stop loss as a safety net, right? It helps you reduce making yourself being emotional when it comes to trading. So when it comes to like how to properly place a stop loss, like obviously I like to focus on market structure. I do not focus on, well, I want to lose. I want to put this 5 pips away. I don't want to focus on that. You focus on market structure, right? That is what is key. Like I'm not gonna say I'm just gonna only have a fixed stop loss. Most people's like you should always have a 30 pip stop loss. You don't know if the market structure is 30 pips, right? You don't know that. So how could people just have a fixed stop loss if we don't know if like because you're looking at market structure? People always want to use technical analysis for entering trades, but how you can't use the technical analysis to help you determine if you're on the wrong side of a trade? You're just saying I'm just having a fixed stop loss no matter what, right? So just like an example, uh, like just use this as an example. It's like when you focus on market structure, because if I ask, like if I say like, okay, where would you take a buy? Where would you take a sell? Everybody know the answer to that. But it always seems like, oh, I don't know where I put my stop loss though. So if this is just an example, it doesn't matter the pip count. We're looking at market structure. We could say, okay, well, this is a range. So this is a range. And then you're like, well, I would take sells because we see that price broke support. So okay, you enter your sells here. So where would you place your stop loss? Where would market structure show you that you're in the wrong side of the trade? When we break that higher high, right? So that is where your stop loss should be, above the higher high. That's as simple as that. Because what most people do is just that they just like, well, I'm gonna put it above this candle right here. You would not be looking for a buy if it breaks above that candle, right? You that doesn't show you you're in the wrong side of the trade. Your stop losses should be where you're in the wrong side of the trade. This shows me that I'm in the wrong side. This shows me that I should not be looking for buys. I should not be looking for sells. Sorry. Right? That's how you place your stop loss above structure. Because most times you can be right with the markets, but your stop loss is here. Drawdown is a part of trading. You're going to be in drawdown. You can't fight that. The reason why most people take drawdown as a loss is because they're over leveraging. So you can't handle it. Most people are like, fuck, that's 100 pips away. The markets don't care. That is 100 pips. Like, that's market structure. That's how you tell if you're on the wrong side of the trade. Most people want to be like, oh, I want to be in a sell right here where I get minimum drawdown. The way you're going to get minimum drawdown is when you're entering when there's a reason. Economic data, news events, right? But when there's no reasons in the markets, you're going to have to deal with this. You're going to have to deal with this shit because yeah, you could probably be in the right direction, but you're probably not in the right direction at that moment, right? So that's the problem. Is most of people are right in the next 5 hours, but you probably got to hold that trade for fucking 5 hours before you hit profit because you're going to be stuck in consolidation because there's no reason to enter the trade. But when you get a reason, that's where most likely the trades that we take, oh shit, we'd be in instant profit, right? But most people are like, nah, I don't want to take it during that time. And then closing when they're in drawdown. So that's just like an example, always above or below market structure. It really doesn't matter how many pips you are. You have to adjust. In order to get that, you have to adjust your lot size accordingly to market structure. I'll go over take profits in a minute. You have to adjust your lot size accordingly to market structure. Okay, guys? Mm-mm. CO2 reports. I can read that on your own. So, good risk management principles, only risking a small percent of your account, right? Like, I already went over that. Like 1 to 2%, at least to, like, this is only for if you're not disciplined. Like, if you haven't proven to yourself yet, all of this is about proving to yourself. If you haven't proven to yourself yet that, I could fucking trade 5%, like, because I'm consistent, I know what to look for. But in the beginning stages, you shouldn't be risking more than 1 to 2% of your account. Because in the beginning, you're not really looking at, like, you're not trying to be fucking Elon Musk right away, right? You're not trying to do that. Like, you're just looking on you're really just trying to work on finding what works for you as a trader, right? And you're trying to figure out, like, okay, this is what I like to look for and for trades. And I know I've been proving to myself to be consistent by doing this long enough. Then once you get to that stage, you're not going to need somebody to tell you, say, hey, you can start risking 5% now. You're going to know when you're ready. Like, if you know that you're not ready right now, then that's where you should be focusing on 1 to 2% of your account. Because when you're focusing on good risk management, then you're gonna be telling yourself, like, oh, okay, now I know what to look for, right? Now I know I understand now the type of trader that I am. Now I can start putting in more risk, right? So all of that is all determined on your growth. But when you first starting, right, just focus on these rules, like focus on risk management. That's what's going to really help you learn in the long run. Because if you're not using risk management, you're not caring about economic data, news events. You're like, yo, I just blew my fucking account off of this trade. That's all you care about. You don't even know why you lost because you're like, oh, this stuff don't work. How it doesn't work if you never letting the trade play out. You can't even let the trade play out because most people over leverage. So that's why this is super key. And then once you get to a point where you're comfortable, then yeah, like trade whatever you like because you already proved to yourself that I could increase my lot sizes. You ain't gonna need somebody to say like, hey, you could double your account now. You're gonna know when the time is right, right? So now let's go to take profits. Why is taking profits important, right? Having a take profit goal, right? Knowing where to place your take profit. Like obviously, take profit is about building discipline, consistency, right? So that's the whole importance of take profits. Let me make this bigger. The whole purpose of having take profits, right? Obviously, it builds consistency, but I just love that it helps. It helps with the greed factor. But having a take profit level, it just again it helps you making those. It helps you control those emotional decisions, right? Where everything is just emotions. Like, man, should I take profit? My man, I think that this trade could run up another 100 pips. We all been there. Greed, right? So having take profit goals is what really helps you when it comes to like, okay, when it hits this first, when it hit market structure at this level, support or resistance, right? That's where I should take my profit, and start doing that long enough because that's what's going to help you build consistency, right? So having a strategy like that, just placing those take profits is really what's going to help you in the long run, and it just makes you avoid making those emotional decisions. So good habits to develop when taking take profits, right? These are the good habits. Having a set take profit strategy before entering a trade. It's all a strategy too, right? Always determine where your profit taking goals are before entering a position. So before you enter a trade, you should know where your stop loss is and you should know where you're going to take profit, right? Because this habit would help you focus on your strategy instead of taking on emotions during a trade. When we're in a trade, you get overly emotional. Markets fluctuate. You're expecting that profit should happen right away. Sometimes they don't happen that fast. But when you understand how much you're risking and then you have a take profit, then you're literally, there's no emotions attached. Let's let the markets do its thing, right? Also, another good thing that I like is profit taking, partial profit taking, right? Take out a portion of your profits when you're up in a trade, right? Leaving the position open because at least you could stop fully exposing yourself to the markets, right? You took some gains out. So when you're up a few amount of pips, right, and you're making those decisions, you see yourself making a motion like, man, I don't know if this is going to continue. You could just take partials. At least you could take something out of the markets and then put it to break even and let the trade run and see if it goes. There's nothing wrong with doing that. And how you're going to know what's best for you is by journaling everything. Record every time you make profits, reasons behind your trades, and reviewing the entries and to take profits. See what helps you more consistently, right? By journaling, right? And also write down your emotions. Like manage your emotions is important. Avoid greed, avoid being fearful. Emotions can lead to overstaying positions and make you exit trades early or be in positions longer than expected, right? So that's why everything has to be a strategy because when your emotions get dictate, markets know traders are overly emotional. It's like you have to somewhat try to be robotic, where that shit can't affect you, right? Where you're just making decisions based off of what's in front of you, not by like, damn, like I don't know, this probably could go higher. Most of the time, when we start thinking that, take profits or take partials. Okay, when it's partials, say like if you enter a one lot, you close half, you want to close 50%, like you close like a 0.50. Or if you want to close 2.5%, like so if you're one lot, you could close partials of the trade. So if you're up $100, you could close $25 and put $25 in your profit in your account. Yeah, you can close partials of your position. So when it comes to the benefits of taking profits, man, it's just more psychological benefits. This is why I say to most people, like when that area hits that first target, it should start boosting your confidence. It makes you be more disciplined. It's like, man, this is what's working, right? Most of us be on the right side of the trade, and you just let that shit just go against you, and it just ruins confidence, right? It makes you feel like, damn, because of reversals happen. You know, like a reversal come in and you just lose a trade. You're like, damn, I was up 30 pips and I didn't take it. And now I got disappointed because it hit my stop loss and I was up and I didn't close when I was in profit. So taking profits should just boost your benefits. And then when you see that shit reverse, you go, damn, I'm glad I closed that trade. Right. So all of that stuff helps, so it just helps you be positive. Like accumulating small wins over time could lead for long-term profitability. And that's the whole purpose. It's like most people just think about the bigger picture. Like you're just thinking about, oh, how can I hold trades forever? It doesn't work that way at first. First, you have to just start building consistency. Then you can worry about the long game afterward, right? But work on just consistently winning. No matter like just hit when you hit that first area structure, right? So for instance, like say again, if you're in a buy, it doesn't matter if this is gold or not. So say you entered here, your first target is going to be, you're going to look to the left, and then you see this is the high. I'm gonna hit, that's my first target. Bam. I don't even care. I'm out. And you do that consistently. And then now if you say, oh, well, this is the second target. I'm looking to the left. This is another high. Bam. I'm out. Right? Same thing for sells. If you're in a sell, okay, well, I'm gonna take profit. The next area of interest of structure to the left. Bam, I'm out. Don't say, well, I'm predict that gold is gonna hit 3,000. So I'm gonna try to hold it until gold price hit 3,000. You don't know that. Just take what the markets give you. Okay. And that's what's gonna really help you in the long run. Right. And just move forward. Well, the rest of this, guys, with key levels, you obviously have access to this in the video because I go into more detail about it. Uh, but this is overall just the bulk of information I want you guys to go. Like in the course, I go over details and I go over videos on key levels and stuff like that, order blocks. So I want you guys to go over that as well. And then, obviously trading live with me is going to be extremely important because then you get to see how everything is executed. All right, guys. So this is the end of this. If you guys have any questions, like right now is the time. But if you guys are good, just put a one. And yeah, guys, hopefully this is helpful. So I want to go over this part as well. Like when it comes to, I don't think I put it, but we're just gonna talk about, all right, at the end. Let's just talk about, yeah, let's just talk about building a trading plan for next week. Right. Because all of us is different. So what I want you guys to do now, moving towards next week, it doesn't matter what pair you trade, what pair you look at, doesn't matter. You guys have to try to do something consistently long enough, right, to see if it works for you or not. But if you want this to work, right, you have to build a plan. So if, all right, I'll answer that. All right, I'll answer your question first. If it's one piece of advice that you know now that you would have given yourself when you first started, all right, so if it's one piece of advice that you would given yourself when you first started, what piece of advice would you give yourself when you first started? What I know now, to go all in with understanding how fundamentals move the markets. Waiting until reasons to take trades. Do not just take trades off of just technicals only, because I've been doing that for so long and I haven't built consistency. The reason why I was in the game for so long was because I wasn't fully in trading a specific way. I was always like learning from one person, taking that course, taking that course, taking that course, staying consistent with one way. And this works for everything, business, it works for sport, everything you could think of. When a person is just all over the place, they can't find success in one thing, right? They're all over the place. So when I focus on just one thing and I stuck with it, that's what sped up the progress, right? It's about forward movement. So if I if I just focused on just like waiting for reasons, that's why I'm about to give you out a trading plan after, because that's what I stuck with. Also, giving myself time to learn to get better. So that's risk management, right? Stop over leveraging because we all been there. I used to always like blow my account, put more money in, blow my account. But if I would have just continued risk management, that would have helped me, like, that would have fast forward my progress. Because every time I lost an account, I wasn't really I wasn't focusing on what was working, right? Because I just blew my account. I'm just day trading every day just to trade. So when I was trading with proper risk management, I was forcing myself to wait for the right opportunities, right? So that was one of the main things that I would have told myself, just to speed up the process, is to go all in on this. I let everything else go. Everything with all these fucking strategies that you learn on YouTube, I let it all go. Nothing wrong with that. Like if y'all learn it from YouTube, nothing wrong with that because there are some people that are successful at it, maybe, but they are. But I let it all go and I just focused on one thing and I stuck with it. I wasn't going all over the place no more because when you look around, everybody is always showing you this next thing. But the moment you say, let me try that out, that's going to push you back 10 steps because it's like you're just all over the place. You can't keep doing that to yourself, because like I've been through it. I really been through it. Focus on one thing. Every person that that are very successful no matter what it is that they do. Like you look at Elon Musk, you look at Kobe Bryant, look at Michael Jordan, you look at Tom Brady, whoever else you could think of that is the best in the industry. Like you look at owners at restaurants, it's very successful restaurants. Alexa Mosey, yeah, like gym owners, like fitness trainers, whoever you look at, they focus on one thing and they work on developing and getting better at that one thing. This is the only industry where people think that they can learn 5 different strategies and put it all together in one and they're going to be successful one way. Everybody thinks that way, right? Focus on one thing. Let all that other shit go. And obviously when you go this route, it's going to be very lonely because not a lot of people think this way. A lot of people, everybody's going to have their own opinions. But when it comes to this, you got to be your own person. You got to figure out what works for you, obviously, and just try to exclude all that other noise. And it's hard, it is, but it works in the long run. Trying to letting go all the shit that I was seeing on social media was one of the best things, and listening to the right people every single day. So that's the stuff I would have told my younger self. And I wish I would have started. I wish I would have did that right away. But it's hard because that's why risk management is key because you're going to be overly emotional. And when you're going through these problems, you're like, fuck, I got to make money now. And it doesn't matter what industry you're in. It's all the same. It's just the laws. It's just the laws of life. It's just like you got to have delayed gratification. It doesn't work that way. When the time comes, the time comes, right? But you have to work on becoming that person to make the money first. We all determine our reality. One another thing too is like you got to see yourself being fucking successful, man. Like you got to tell yourself this shit every day. Like I'm the fucking best at this shit. Like if you're not telling yourself that shit, you already lost. Like you have to have so much confidence to trust your analysis and trust your judgment. You got to trust your judgment, right? Because that's all that it is it's a choice, right? So that's why, like, if you're not making the right choices every day, how the fuck are you gonna expect to make the right choices in money? Like, is his money every day? That's fluctuating up and down. It's not as simple as somebody just go to your restaurant and buying food from you. Like that's money that I take, I put in my cashier. That money's there. When you're in a trade, you're seeing the money moving up and down, up and down, up and down, right? So it's more emotional. So we have to have a different type of mindset when it comes to this, and know that it's a strategy, it's a skill. It's not luck, it's a skill. You know, and you learn all of this stuff by just seeing like how a lot of people operate. If you literally just do the opposite of what most of these motherfuckers are doing, like you will find somewhat a success. If I tell you like what is everybody doing right now in the markets, like what are they all doing that you like, damn, that's pretty stupid. You could write a whole list down of what a lot of them do. You just gotta do the opposite. Yo, James, I hate seeing traders on IG. All they try to sell most people is a fake dream with Lambos and 100K cash. Yeah, like because it's selling is a business too, and we can't get mad at the game. because that's what majority of people, that's the goal. That's they showing like this is the goal, but this is how I got it. But most people have to experience that turmoil themselves. You have to go through it. It's like, yeah, well, I'm looking up to this guy. I'm gonna buy this shit from him. And then when you go through it, you're like, you've been doing it for 2 years and you seeing that person's life improving, but you've been doing the same shit he's been teaching. And then you're like, where the fuck is my Lambo? Where's my 100,000? Right? Then you realize, okay, some not really some ain't really shit adding up here, And then like, cause most of them ain't really telling you the reality. Like we all live in America. Like you want a nice car, get good credit, right? Like I don't do this for a car. I don't do this for the flex. I don't do this to flex. I do this shit because I want to be the best at this. Like there's a reason why people ask me every fucking day to invest money for them because I choose to be the best at this shit. Like if you're trying to just do this shit for a car, you already lost. Like people that like this is just what it is. Obviously, that's the reward of being good at the shit. Like the reward is like you're gonna be, you do what you want when you get that money, right? Obviously, if you get that, you could flex all of that stuff because that's the reward of being great at something. Like people is gonna pay you. Like people, you're gonna be having money to do what you want. That's the reward, right? That's how you look at it. That's the reward of this. So you when you get to that point, but you only could get to that point once you become good. But you have to work on like try every day, just try to be the best version of yourself. Like what does the highest version of yourself look like and how they act? Because now you have a goal. Now you know what to reach. So now every day when you're fucking around, you know that damn, I'm not gonna be that person that I admire. Right. So every day you're trying to reach that person, like yourself, how would you admire yourself? Like when you look at yourself and say, like, okay, what do I look like in order for me to admire me? Right? And when it comes to trading. And then when you do that, then you're like, okay, now I know what to do every day. How would I take advice from myself as a trader? What is the things that I see myself doing every day? And the shit is hard and it's uncomfortable, right? So that's the goal. Like that's what it takes. But most people is being sold in this shit that is just you can just sit on a computer and you can just buy and buy and sell. You're just making a shit ton of money. Like that's what's being sold. People expect it to be easy, and then when they realize they're like, fuck, it's not really that easy, like what is it's probably a strategy that I'm missing out that's not really showing me something. So that's why risk management is very key because losses is going to happen in the markets, but it's about controlling your risk, right? So now when it comes to building a trading plan, right? Like every week, you should look at economic data and you understand what is important, what is the main focus for the week for whatever currency, right? So if I'm looking at the Federal Reserve, I know that, all right, there's a possibility. We got a rate decision coming up now. Lately, I've been seeing economic data is showing strength in the economy, strength in inflation, et cetera. So if I see data this week and I see that there's CPI, I see there's labor data, those are the two events that I'm going to try to be present for to trade. Why is that? Because that could actually impact the currency. So if I understand if the data comes out higher, that should strengthen the dollar. If it comes out weaker, it should weaken it because it would influence the interest rates for that rate decision. So now I have two opportunities that I look for that week, right? Obviously, then also you're going to pay attention to what else is important, geopolitical tensions. So I'm going to be aware of these tensions because if things escalate, I'm going to probably be looking for opportunities for a stronger yen currency. So I just don't know the time that is going to happen, but that's something I'm going to be aware of, right? So for the week, you have a plan on execution, right? So when you're looking to trade, you should know what days you want to trade, what session you want to trade. Is there something important happening for that session, right? So nothing is random. Like you should know the time, you should know the asset, and you should know what is the data, and you should know like if it's a buy or sell, what do I need to see in order for that to happen? We just don't know the price action before that day comes, right? But at least you have something planned and then stick to it. Because yes, there's going to be a Monday where nothing is going on. But if you have a plan of execution for that day, that Monday that nothing is going on, you should leave the markets alone. Yes, markets move up and down and there's always opportunities. There is. But you're looking for your opportunity. You're not looking just to force an opportunity because the markets is moving. Look for your opportunities first. Prove to yourself you can win by your opportunities. And then once you start building that consistency, if you want to trade a Monday just because you see a technical break, give it a shot because you know already how to make money consistently. Prove to yourself I can make money consistently by following these rules. Because once you start doing that shit, you ain't gonna trade a Monday when there's nothing going on. Because you already know, like, hey, I know what works for me and I'm gonna stick with it. So you have to find what works for you, but trade when there's reasons. So if always paying attention to headlines is key too. Like, right, if we see that Jerome Powell is speaking on Friday, wait until Jerome Powell speaks because you know that a central bank speaker can influence the markets. Maybe Friday would be the only opportunity you take. If that's the case, make that the only opportunity. Most of us also trade a lot too much for the day, right? We take 5, 6 trades a day. Only take two trades a day. Like for the week, try to take 5 trades for the whole week. If you only could take one trade a day, take one trade a day because it's about the less risk you put into the markets, right? It benefits you because if you're just constantly trading, you're always going to see that break even mark, right? Because you're not even focusing on the right reasons. You're just over trading. So when you're focusing on taking trades when there's reasons, you allowing yourself to only focus on the time that you can profit from the markets, that you can make money from the markets, right? And then when you're working on risk management, even if you take a loss, it's just one trade. Because if you're only losing 1 to 2% of trade, when we win trades, sometimes those wins are 4 or 5%, right? So you're always looking to increase your amount of profits than your losses. Your losses is always at a cap, but your wins is never capped. You never know. Your wins could be 3, 5, 6, 7, 8, 10% wins. But as long as you can limit those losses, you're always moving forward in the markets. Forward progress. All right, guys. So this is it. I appreciate you guys being here, man. Hopefully this was helpful. And I want to see profitable trading from this afterwards, right? Knowing all of this stuff, right? Obviously, not expecting to make $1 million right after this, but at least this is going to put you in the right step because now you're going to know what to look for. And you're going to be like, oh, now I know, like, okay, now I understand why this currency is stronger and weaker. Now I can understand, like, oh, if these tensions de-escalate, that's an opportunity, right? Because now you're putting your mind as an institution. Now you look, these people that invest in billions of dollars in assets, this is what they look for. You never, when you hear these guys talk, they're not talking about a chart, right? Obviously, you need charts to help you enter the markets, but when you see these things happen visually, mentally, you should say, oh shit, this should weaken this currency or strengthen this asset. Like this should, oh, this is an opportunity. Like right away, your mind is going to tell you, oh shit, this is an opportunity. And that's the goal. Okay. Like you're going to be like, oh, this is an opportunity. And then you're going to understand what is an opportunity. All right. And then after that, that's when you take your trades, you take your entries. And obviously, like when you go through the video, you're going to look at the order blocks, right? You're going to go through the order block video. I explain my entries in the video in the course. You're going to be able to go through all of that too. But the goal is to like understand like the opportunities, right? And that's what's going to help you long term. Most people just think about now, like think about being in the game for like the next 5, 10 years, right? How are you going to do that? You know that over leveraging ain't going to get you there. And you know that not understanding this stuff is not going to get you there. Because imagine if you learned this information back in 2008, if you was around that time, imagine you learned this information in 2020, what kind of opportunities you took advantage of. Imagine if you had known this information the day of the election of Trump. like, like what you would have did with the dollar. Like, imagine if you'd known that then. Just what, a few weeks ago, right? Imagine you'd known this when Trump said that about tariffs. Like, what you would have done then. So now it's just about you understand the opportunity. Yeah, maybe you miss a few, but at least you like, fuck, I knew this was gonna happen. And that's where it starts. You're like, oh shit, I knew this was gonna happen. Oh, that's where it starts. Right? So now when you read central bank headlines, oh, this is hawkish, and you see a currency rising, you probably missed the opportunity, but you're like, oh man, I knew this was an opportunity because he said this. And that's how it starts. Right? And then after that is entries and all that other stuff is all after that. But first you have to understand what's moving the markets. And then everything else with technicals and all that stuff, that's all after. All right, guys? Yeah, I appreciate you guys. And yeah, and again, in a group, have any questions, don't hesitate to reach out. and enjoy your weekend, guys.